are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site, whereas this we can do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Crisis averted. The debt ceiling bill clears the Senate, removing the risk of a U.S. default. The measure now goes to President Biden for his signature. Now attention turns to today's U.S. jobs report. The data may show a slowdown in the pace of hiring that could potentially allow the Fed to pause its tightening policy in June. And Broadcom predicts that sales tied to AI will double this year, though the chipmaker remains mired in a broader chip slowdown. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And Kriti, we are done then with the debt ceiling. That came and went. We're done with that through the House, through the Senate. But now we move on to the jobs report.
Yeah, we really do. And it doesn't matter whether or not we get this relief rally when we are talking about potentially growth concerns at the end of the day. We go right back, snap right back into that inflationary story and what that means, not just for the Federal Reserve, but central banks around the world. And look, you're already seeing a little bit of optimism baked into futures here that perhaps we might get a little bit of weakening in the payrolls numbers. But don't let the green on the screen fool you, because even though futures are higher by about 0.4%, a big part of the story is getting in on this kind of tech-crazed rally. Essentially the idea that in the last couple of weeks, you have not only seen the kind of lack of breadth, but essentially the idea that a handful of names are really seeing very, very few sellers on the market. Even any pullbacks, even like of what we saw yesterday, for example, not an enormous margin. So a lot of folks still kind of piling into the tech story and by extension, the benchmarks as well. And it's nevertheless 0.4 back on that futures contract higher. Again, that may change as we get that payrolls data. The 2-year yield also, of course, in focus coming off the economic data, 433 on the front end of the curve, kind of unchanged right now, but really interesting to see that it has stayed sustainably above 4%. That just really reflects the idea that the market is pricing in a Federal Reserve that is simply not done hiking, which is why you're seeing that front end of the curve really sell off. So important to keep an eye on that and how that changes when we get the data in just a few hours. And of course, with the yields coming, or at least directionally moving lower, and you've seen that tick by tick overnight, the dollar is following down to the tune of 0.2%. Latest weakness coming in the dollar based off of what you're hearing over in China, simply the idea that they are weighing a property market support package to boost the economy. That is a really important story when we talk about Chinese growth and how that's reflected in assets like the commodities market, which brings me to NYMEX crude, a 71 handle there, Anna. We are seeing a little bit of green on the screen. Of course, like I said, I want to come back to the currency picture because see this latest tick for our radio audience, stick with me, that tick lower, that weakness that you're seeing in the dollar relative to the offshore yuan coming off those China headlines. We are looking at 707 on that exchange rate, Anna.
Yeah, interesting. If we had seen some robustness in some parts of the Chinese economy, manufacturing and property were areas that people had concerns about. So that's an interesting red headline to keep under review then, Chrissy. This is the picture in Europe. We see a positive picture really for equity markets here in Europe, maybe getting another level of positivity coming through from those Chinese headlines around the property market. But broadly speaking, it's been a positive start to the trading day here for European stocks. And we're looking ahead to the jobs report, but comforted by the news that we have on the debt ceiling coming out of the United States. Make note of the bright area of green down there in the corner of the map. That is, of course, the Turkish equity market, and we'll come to that just now. I'll show you where we are on the Istanbul market because we've had some really interesting reporting from our colleagues out of Istanbul suggesting that Mehmet Semsek, who's somebody who was previously finance minister in Turkey and has been deputy prime minister in Turkey, could he be coming back to the top table, back to the cabinet under the President Erdogan? Well, that's what our reporting suggests. We'll get confirmation of that or not over the weekend. But if that were to be the case, he is somebody who is known, very much a known quantity for markets and somebody with a much more conventional take on financial policy or monetary policy than some of the other voices we hear from in Turkey. This is SBB. These are a couple of stories out of, that have a Scandinavian angle to them. This is SBB, the Swedish listed real estate business. This is the poster child for the troubles that the real estate sector has been in over in Sweden. And now we understand that Brookfield, the Canadian investment business, might be interested in buying the company, talking to the company about that, taking on some of the assets. We don't know. It's still early days, but the stock up by 26.5% as a result of the news flow surrounding that. And here's another story which has a Scandinavian element because EQT, the private equity business, is considering, has made an offer for Dechra Pharmaceuticals. This is a pharma company that makes pharma products, not for people, but for pets. A lot of money in that, it would seem. But they recently put out a profit warning, and that had led some in the market to question whether we would see this deal come to pass. The stock is up by 8.3%. And you had WTI, I've got Brent, Chrissy, as we just keep an eye on what's happening with this oil price as it edges higher the closer we get to that OPEC Plus meeting.
Yes, certainly something we're going to be keeping an eye on throughout the weekend. But again, we are still waiting for that final seal of approval in Washington. The Senate passed legislation to suspend the U.S. debt ceiling and impose restraints on government spending through the 2024 election, averting a default. Senate Majority Leader Chuck Schumer spoke of after the vote cleared Congress.
This demanded a bipartisan solution. We knew we'd need to come together for a solution like the one that passed tonight. And so I'm happy to stand here passing this critical legislation to support our families, preserve vital programs, and most importantly, avoid catastrophic default.
Joining us now to break it all down, Bloomberg's Rosalind Matheson. Rosalind, can anything go wrong from here?
Well, unlikely to, because of course it's passed Congress, it's passed the Senate, just needs Biden's seal of approval. And of course he's going to address the nation later tonight in the US to talk to the American public about what this deal means. And so really it is a done deal at this point. And what it does most of all is it takes the debt ceiling off the table for 2 years. That means through the US electoral cycle in 2024, which is probably a big relief to everybody. So it's off the table for that. It caps spending for only 2 years, not 10. So obviously that also means it's off the table during the election cycle. But really, a lot of the deal is still unknown. We know there's going to be certain measures where students will have to start to repay their loans. We know there's going to be restrictions and perhaps cuts to some services for poorer people, but a lot of the detail still has to be worked out. And so the deal itself is fine, that's through, but really the reality is now we get down to the nitty-gritty on some of the deals, some of the spending areas that are going to have to be cut or trimmed. The Congressional Budget Office estimates $64 billion has got to be found, and pretty fast. That's a lot of money to find in the cupboard or behind the back of the couch. And so we can expect a lot of messiness going forward in the next couple of months, because that has to be agreed also by October.
Ros, how would you characterise what we've seen play out here around this debt ceiling debate? Because we spend a lot of time talking about the bipartisan infighting that we see in Washington, and we feared that perhaps some lawmakers might want their moment in the sun and make a big fuss and therefore push the US into some sort of default. That hasn't happened.
Well, that's right. We always expected it would go down to the wire because it makes political sense for either side to do that. But did you want to be the one that drove the bus off the cliff in the the US, probably not going into the election, and so there was always the incentive to find a
enough to excite investors, though. Why is the stock down to the tune of 3.7% in the pre-market? Walk us through it.
It looks very much like it's to do with the full year outlook, which is sort of in line with analyst estimates, in fact, slightly below. They're looking at the low end of what analysts were expecting. That seems to have, disappointed investors to a certain extent, even though the numbers in the current quarter were slightly better than had been expected. So it's really looking towards the full year. Of course, Dell benefited significantly during the pandemic as plenty of people and companies invested in more computing tools. Dell was a beneficiary of that. That makes it quite hard point of comparison when we look into this year, into 2023.
Alex, thanks very much. Bloomberg's Alex Webb with the latest on those tech themes. Let's move from tech to oil. OPEC Plus is meeting this weekend, and it will be grappling with a divided oil market that's torn between a rebound in demand and recession fears. Joining us now here in London, Will Kennedy, Bloomberg's Senior Executive Editor for Energy and Commodities. Will, good morning to you. So the market has been soft for the last few weeks. Do we expect OPEC Plus to change policy at this meeting? They did it in April. It was a surprise then. They did it in October.
I think it's hard to say as of Friday morning. I think the meeting is up in the air to some extent. As you said at the beginning, there are reasons for OPEC to perhaps consider steady as she goes or a further cut. The market is clearly soft and has not gained any traction from that surprise cut in April, and I think that will be a concern to some members and may want to do something about it. On the other hand, there is still this expectation that the market will tighten in the second half of the year and that global inventories will start to fall. And I think for any cut to take place, members will want to be reassured that Russia is going to participate. One of the issues is that it's not clear from the tanker tracking that we see that Russia has followed through on the 500,000 barrels a day cut that it pledged earlier in the year. And until that happens, I think some members will be reluctant to cut further.
I've got to say, it is pretty cool that our oil team gets to track tankers minute by minute. We, of course, applaud that team, as always. But, of course, the run-up to the meeting has been overshadowed by the bar of Bloomberg and other reporters being barred from the meeting. Will, talk to us about access when it comes to these developments.
Well, as we wrote earlier in the week, OPEC changed its policy for press. Normally, you could just apply to be accredited to the meeting. Now they sent invitations to reporters, and no Bloomberg reporter and no reporter from Reuters and many reporters from the Wall Street Journal did not get those invitations. And at the moment, as of Friday morning, we still haven't been invited, and as such won't be able to attend the meeting over the weekend. I mean, I think it's a great shame. Bloomberg has covered OPEC for 30 years, Reuters for longer. We want to be there, but we don't know why we're not. And we've asked the Secretariat at OPEC to clarify the situation. They haven't yet been able to do that. I don't think this is in line with their stated mission to bring transparency to oil markets, but the ball is in their court. All I can say is the whole team will be there as usual, covering the event as best we're able and bringing the news to all our readers and viewers.
Well, thanks very much. Bloomberg's Will Kennedy then, as we look ahead to those OPEC Plus meetings taking place at the weekend. Now, coming up on the programme, we'll get back to broader macro themes. We'll speak with Elliot Hentoff, State Street's head of macro policy research, on the growing headwinds amid a debt limit resolution. We're back to talking about high inflation, though. We're also counting down to the US jobs report. That's due at 8:30 a.m. Eastern Time. Former Fed Governor Randy Kroszner joins our special coverage before and after that report hits the Bloomberg terminal. This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. everything you learn is additive every day. And if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping. Look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
So far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jake Powell thought he'd be looking at.
It really signals an employment market that's chugging along.
Miles from where the chairman of the Fed wants to be.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May Jobs Report, today on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, one of the big questions about this rally is whether or not it's sustainable. And the core of that question is, if it's sustainable, why are we seeing such narrow breadth? Is this one of those times where the exception may actually apply? And I want to bring a chart to your attention. For our radio audience, stick with me here. We are essentially looking at kind of sector performance in the S&P 500 and what has led to the rally. And we're looking all the way to the right side of this chart, which shows, again, extremely narrow breadth. We are seeing green on the screen, but it's only led by a handful of companies. And that's really different than what we've seen going back about the last 10 years or so. We don't see this kind of narrow breadth often matched with these kinds of gains. But I have to say, there's an argument that says, look, there is real money entering the technology space, the AI space. So perhaps that rule of breadth equaling sustainability doesn't necessarily matter for the bull market. That may or may not be true. Let's bring in a true expert, Denitsa Sakova, our Bloomberg cross-asset reporter. What's your take on the story? Is breadth needed for a sustainable rally?
Yeah, of course, like we can see a very narrow breadth all over the sectors. We can see it if we compare growth and value. There has been incredible outperformance of growth drawn by quite a few stocks. You can see it in the S&P 500. If we compare equal weighted, that kind of removes the value bias versus the original S&P. And then the gaps also are record. We're seeing the widest gaps in 30 years. Whether this is sustainable, of course, a big part of it is IE optimism, but we have to remember that also we had better than expected earnings that lifted sentiment. We also had a defensive bias, and investors fleeing to safety, and some of those companies have strong balance sheets, so that's a big factor. Another thing we're seeing is there are big inflows into stocks this week. Latest data by EPFR shows. So there is actually money coming into that rally. How far it will go, of course, there are a lot of factors, economy, Fed, so it's too early to say. But there is some belief in investors that this might be a good time, at least the last week, to put some money back into stocks.
Okay, so that's interesting on the breadth of what we're seeing. In terms of where the excitement comes from in technology, clearly AI, it was such a buzzword for a long time, and then we saw some actual bottom line impact of it from the likes of NVIDIA. This has created, obviously, a lot of buzz, but you say that some of the active managers didn't see this coming. What's the story there?
Yeah, for sure. So active managers were actually quite underweight technology stocks, so they missed a lot of the rally, and some people are attributing part of the rally because a lot of people there was a heavy activity in calls, so a lot of people were kind of chasing the rally and trying to catch up on this AI hype for the last week. So that was that was also supporting markets. But we're actually seeing some flows of people buying this week, along with active manager catching up on what maybe they've missed in the last few weeks.
What's the overall mood in markets like then, Denisa, as we seem to have put to bed the concerns around the debt market, the debt ceiling, sorry, in the US. We wait to see what exactly that means for Treasury, for issuance, for corporates and for governments. And then, of course, we're moving into the jobs report, so very quickly we'll be into digesting what all of that means for the Fed in the month of June. What's the overall mood?
Yeah, so if we look at, for example, the VIX or the zero-day options, markets are quite calm. VIX is below 16, which is really calm. Going into a jobs day, the zero-day options is actually the quietest we've seen it in a year. Generally, positioning is neutral. There hasn't been, there hasn't been big buying or selling in the last few weeks. Of course, we have that big jobs report coming today. We have inflation data coming on June 13th. So there are so many things that can change. Of course, we haven't seen a big rally after the debt ceiling. There are a lot of issues about liquidity, what happens after this big T-bill deluge that we're probably going to see next week. So, we've seen improvement in sentiment, but we haven't seen any actual actions because investors are perhaps liking for all those potential headwinds to maybe pass by.
Denisa, thank you very much. Denisa Sakova joining us there from the Cross Asset team with a look at the markets. For more market analysis, you can find the Markets Live blog at MLIV Go. That's the function to use on the Bloomberg terminal. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Now keeping you up to date with news from around the world, here's the first word. Ukraine's air defense says 15 cruise missiles and at least 21 drones were shot down in the Kyiv region today. Ukraine's capital has been attacked by Russia from the air on each of the past 6 nights. No casualties were immediately reported after at least 3 people, including a child, were killed in Thursday's barrage. Meanwhile, drone attacks have been reported across a widening swath of Russia. Bloomberg has learned Turkish President Recep Tayyip Erdogan will tap Mehmet Şimşek as his new Treasury and Finance Minister. Şimşek is an advocate of conventional economics. Supporters say his appointment will likely shore up market confidence. Şimşek is set to be in charge of all of Turkey's economic policies in the new cabinet. Erdogan won re-election on Sunday, extending his more than 2 decades in power. Jamie Dimon will visit Taiwan after wrapping up his high-profile trip to China. The stop-off by the J.P. Morgan CEO comes at a time of heightened tensions between Beijing and Washington. LVMH CEO Bernard Arnault, meanwhile, has become the latest big company boss to announce plans to visit China as Tesla CEO Elon Musk returns from his whirlwind tour of the country. Goldman Sachs is warning of a sharp slowdown in its investment bank compared to the bumper gains a year ago. Its president, John Waldron, says the trading business is trending down more than 25% this quarter. Goldman is working on what would be its 3rd round of job cuts in under a year. A lot of movement in the financial industry, Anna, from job cuts to diversifying regionally. You can really see a lot of the big players on global Wall Street really starting to feel the pinch.
Yeah, a lot of interesting themes going on there. Interesting, you mentioned Jamie Dimon's trip to Taiwan, and we understand other leaders of US businesses have made that visit. The boss of NVIDIA, very newsworthy these days, he was there not all that long ago. I was taken by that Goldman Sachs story, though, because there's a contrast there, Christy, between what they were saying about the environment they see and Bank of America saying that for them, the quarter appears to be flat-ish when it comes to those same markets. So we'll continue to watch the investment banking story, the FICC story, the equities trading story, and see how these trends develop through the quarter. Coming up on the program, we'll get back to the macro markets. Elliot Hentoff joins us, head of macro policy research at State Street Global Advisors. That conversation next. This is Bloomberg.
The world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement
and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Crisis averted. The debt ceiling bill clears the Senate, removing the risk of a U.S. default. The measure now goes to President Biden for his signature. Attention turning to today's U.S. jobs report. The data may show a slowdown in the pace of hiring that could potentially allow the Fed to pause its tightening policy in June. And Broadcom predicts that sales tied to AI will double this year, though the chipmaker remains mired in a broader slowdown. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot to digest there. We're kind of reverting back to those old concerns, inflation, growth. I wonder which takes the cake in today's data.
Yeah, absolutely. We'll certainly be focused on the labour market later in terms of data, won't we, Kriti, and what that means for the inflation story. More on that labour market dynamic in a moment. Let's have a look at where we are on the European equity market story then, up by just over 1%. Relief at the passing of that debt deal through not just the House but the Senate. Also a little excitement perhaps about the Chinese coming in to support the property market. That headline at the top of the hour perhaps lending some extra support to European stocks, and that market, the European market, sorry, certainly doing pretty well this Friday. The Turkish stock market doing well, as we understand, according to our colleagues reporting in Istanbul, that we might see the return of somebody who used to be Deputy Prime Minister coming back into the finance ministry over in Turkey under President Erdogan. But if Mehmet Semsek does come back, he's a known quantity to markets, somebody with quite conventional views, former Wall Street banker, so somebody who the market knows and understands, and that is putting some positive momentum under Turkish stocks today. This is SBB, that long name we usually shorten to SBB, the property business over in Scandinavia, in Sweden. And we understand that Brookfield could be interested in coming in and buying up this business or buying parts of the portfolio of this property management company. And so the stock is up by 28.4%. Early stages, those talks, but talks have been taking place in London, we understand. Dechra Pharmaceuticals, a pharma business, Kriti, but not for you and I, it's for pets. But this has been the subject of a takeover approach from EQT, and as a result, that stock up by 8.4%.
I love that you mentioned the pets. Harvey, my puppy, will be very happy to hear that development. Anna, the stateside story is pretty similar to what you're hearing in Europe, especially when it comes to sentiment. Remember, the China story is absolutely playing a role when it comes to the state story. Remember, after the global financial crisis, part of that global recovery was this massive investment and stimulus from China. So really kind of incorporating that Chinese growth story, the idea that the Chinese Communist Party and the central government might actually be able to prop up the Chinese growth story is a positive, even for S&P futures, which have been ticking higher, similar to what you're seeing in the European session, to the tune of about higher by 0.5%. But I got to say, when it comes to the bond market and the FX market, it's likely to be all about that payrolls report that we are going to get in just about 3 hours. The two-year yield at about 4.34, hovering over there in a little bit of a wait-and-see approach, because that payrolls data, Anna, is going to change the game when it comes to market pricing of whether or not June is a pause, a skip, or potentially another hike. That's really the data point that we are waiting for, and likely going to lead the story for the dollar as well, seeing some weakness in the greenback, down about 0.2% in the opposite direction to the yield story, which is interesting. The ripple effect of that is going to be a little bit of a tailwind to the commodity space, despite those growth concerns that we are talking about. NYMEX crude trading at a 71 handle, higher by almost 2%, also likely trading off, Anna, that Chinese story that we were talking about.
Okay, let's get to a macro conversation. Elliot Hentoff joins us, Head of Macro Policy Research at State Street Global Advisors. Elliot, really nice to speak to you this Friday, and the perfect voice to have on the day the day after we've seen the debt deal pass through the Senate. So we're a little more certain that is going to be an issue avoided, no US default. But what does that mean for Treasury markets? Because for some time now, we've seen this sort of dislocation at the short end of the Treasury curve because of concerns around the debt ceiling. Now that's resolved. Now the Treasury goes out and issues and investors pile back into that period. So what is that going to do to liquidity in the markets and to broader market themes?
Well, the first thing that we could track is that on our behavioral risk scorecard for institutional investors, we've seen a slight kind of comeback in terms of risk appetite. So clearly the resolution of the debt ceiling issue has been positive for markets. Now, with regards to treasuries, there's obviously a massive issuance that's going to happen. That was always going to be the case, regardless of when the debt ceiling would be resolved. The mechanics of that are that there's a net withdrawal of liquidity from the market. The question is, where does it come from? And that matters a lot. Does it come from bank reserves and basically further kind of inhibits and shrinks the banking sector's ability to lend and extend credit? Well, that would be macro, quite negative for macro. Or does it come kind of from reserve repo facility where money's just sitting and being parked at the Fed anyhow? Then the macro impact is a little bit less. But nonetheless, it's a net liquidity withdrawal. And the important thing to remember is that in the first half of this year, the Treasury just depleted its cash pile. So some of the GDP figures are a little bit flattered by the fact that we basically had cash of the tune of 2% of GDP that was basically at no cost. It didn't have to be borrowed. It didn't have to be financed. It just was depleted.
Could it come from other parts of the bond market? Is that a possibility? I mean, where do you think it's going to come from? What impact do you think it's going to have then, Elliot?
I think it'll be a mix of all. Some of it will come from abroad, or it'll be foreign investors that actually decide to leave more money in the US market than expected, so that in the short term is supportive of the dollar. But by and large, we think it's a mix. I think the more optimistic view is that a lot of it will come it'll just wander off from the repo facility at the Fed and off into the Treasury bill market. But that's a benign view. No matter what, net, it's a negative. The question is, what's the magnitude?
So, Elliot, that is the U.S. story. Let's talk about the China story here, because it starts to feel like the narrative, in the absence of kind of the debt drama, has really shifted to the growth story. How crucial or how underpriced is the China story right now when you're looking at European and U.S. markets?
Yeah, I'm a bit puzzled by this whole discussion around the disappointing macro data from China. The day China reopened in December, we had a forecast of GDP growth of around 5% for 2023. And 6 months later, we're happy with our forecast. It's unchanged. We think we're on track. We actually think the normalization is proceeding roughly along the lines of expectations. Our view was a little bit below market, and I think perhaps the markets got a little bit too excited that you'd have this highly accelerated reopening process, the way you had it in Western Europe and the US. Obviously, China was always going to be a little bit different. Property is a structural weakness, so trend growth for years to come will be lower in China. But I think the important thing to remember is that this is just a slower process, so it may last a little bit longer. We have kind of 4.7% growth penciled in for next year. Again, lower than pre-COVID, but these are decent numbers. We're kind of still confident on the China story.
You're certainly in the camp of the growth is growth at the end of the day. A fair argument to be had. Elliot, what we love to have you on the show for is your kind of marriage of both policy and the markets. Talk to us a little bit about whether or not this market should be even concerned about the geopolitics at play, because even though it does feel like Beijing and Washington, for example, are perhaps at heads, you are seeing these headlines that Elon Musk, Bernard Arnault, Jamie Dimon, you name it, they are making trips to both China and Taiwan, what do you make of that? How does that kind of compare and contrast with what you're hearing from your clients?
It's a bit paradoxical because in the near term, our advice has been to ignore geopolitics. It's not market relevant probably for the most of this year. We're much more worried about next year, where you actually have a variety of event risk that comes back. One is probably some type of peace process on the Ukraine war, where China's role is pivotal, and there's negative spillover potential. There's the Taiwan presidential election, the US presidential election. So we're worried about next year, but for the coming months, it's clear China's prioritizing normalization of the economy. The US is trying to put in guardrails in terms of the US-China relationship, and therefore it's not really a market story for the coming months. It will return in a big way because the long-term trajectory is clear. Greater risk, greater spillovers into markets in a negative way.
We started this conversation talking about the US, and I'll pivot back there, if I can, around the Fed thinking at the moment, Elliot? What is your thinking around June? Are you buying into this idea that we get a skip? It's a new word for a pause, apparently, but it means you go back to hiking afterwards. What's the thinking for you?
Skips are very unusual in central banking. It's just not what central bankers typically do. We've only had one Fed hiking cycle ever where the skip became kind of a habit, and that was the last one in 2015. That's when deflation risk was kind of pronounced post-financial crisis and otherwise. The reality a skip is actually rather unlikely. You know, if there is that pause, it probably means that we hit peak Fed. Again, back to the Treasury bill issuance, you're going to have some liquidity conditions deteriorate over the summer. So it's hard to make the case that why would you hike in July when kind of a lot of the liquidity headwinds make themselves felt when you're not doing it in June?
Okay, Elliot, thanks very much. Thanks for joining us. Good to speak to you today. Elliot Hentoff of State Street Global Advisors. Coming up on the programme, riding the AI wave, we will hear from the CEO of the software developer C3 AI and take a look at the growing interest in AI-powered avatars. This is Bloomberg.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains. And any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Let's turn back to the AI frenzy that's been fueling the tech sector. One of the biggest players in this space is software developer C3 AI. The company CEO spoke on Bloomberg yesterday. He says the AI rally, it's not overdone.
Well, looking at the big picture, when you see the people who are making the semiconductors that are running these AI applications announce that they're increasing, almost doubling production. In the case of NVIDIA, I think from $7 billion in chips to $11 billion in chips in 1 quarter. I mean, this is unprecedented, I think, in the history of the semiconductor industry. And so I think that's proof positive that this AI phenomenon is very real, just in the amount of, CPU consumption that we're utilizing.
Well, let's talk about your company specifically and your earnings. Your revenue forecasts were seen as disappointing, but you note in your own earnings as well that you've got a limited list of clients, in particular a reliance on deals in the energy space, companies that use your software to analyze huge amounts of data. Outside of energy and defense companies, who are you getting calls from right now?
Well, if we look at our the industries in which we did business last year, we did about 33% in oil and gas, almost 29% in defense and intelligence, 13% in high tech, 11% in energy utilities, 5% in each in manufacturing, food processing, chemicals, life sciences. So it's getting increasingly diverse.
Now, as the CEO of the software developer C3AI, let's stick with the AI theme, as the generative AI frenzy continues to ramp up, its applications in media, e-learning and communications are drawing new interest. The digital avatars market is growing fast and is expected to top $525 billion by the end of the decade. Tom McKenzie, our colleague here at Bloomberg, spoke about this with his, yes, this is real, very own digital twin.
They can revolutionize industries such as entertainment, gaming and virtual communication. Avatars have the power to enhance user experiences, enabling immersive virtual interactions and personalized content. They can facilitate remote collaboration, telepresence, and even assist with customer service.
Well, this just got a whole lot of weird because that was Tom talking to Tom, and Tom just joins us now here in London on set. This is the real Tom, the Tom McKenzie that I prefer, as opposed to the slightly stilted avatar version. Tom, tell us about the process then of creating an AI-powered avatar and then talking to yourself.
So there's obviously a lot of threads to the AI story, and one area that we wanted to explore and understand better, partly for self-interest reasons, is digital avatars and digital twins. So we worked with a company called Synthesia. They're at the leading edge of generating these digital avatars. We went into a studio in East London. I recorded some voice tracks, a lot of voice tracks. Some of the language were very strange, and stood in front of the camera and did some movements because, of course, they want to be able to put all of that data into their AI-powered algorithm to build out this avatar. It took a bit of time to process all of it, but the deal is once you've got this avatar, you can get it to basically say whatever you want it to say to. We used ChatGPT for these answers. So we went to ChatGPT, asked some questions to ChatGPT, we took that text, put it in the avatar, and those are the responses that you're hearing. So that's a bit of the background behind how we produce this.
Put some numbers on it for us, Tom. I mean, that looks like a lot of fun, but why would someone actively invest in this?
Yeah, so the business case is this, and Synthesia, they work with about 15,000 clients, they say, including the likes of WPP, Ocado, McDonald's, Amazon. And the case that they have is a lot of this is used for internal communications for some of these big companies. So you can imagine the CEO or an executive, he or she wants to put out a message across their global teams. They generate and build out an avatar, and then they can get the avatar of themselves to generate and deliver that message, whether it's in Spain or China or back in the US, because they have about 120 different languages that they can program around this. Top line, according to some research, this could be an industry, this could be a particular sector, digital avatars, worth about $530 billion just by 2030. What Synthesia says, it reduces the cost. You don't have to spend all that money on camera teams and audio and all the rest of it, editing. You do it once, costs about $1,000, and then you can reuse your own avatar for delivering those internal comms messages. But you can imagine that the door is open now to much wider use as well.
Yeah, I mean, I can see the attraction, but you also have to wonder how the message lands, I suppose. If you don't send the CEO, you send the CEO's avatar. I wonder how the messaging comes across. What are some of the ethical concerns then and the risks surrounding this?
Well, they're numerous. They are numerous. And, you know, look, I actually put that question to my own digital twin, my own avatar, on the risks, some of the ethical concerns. So take a listen to what I or it had to say.
Ethical concerns arise, including issues related to bias and fairness in AI algorithms, transparency and explainability of AI decision-making, data privacy and security, and the potential for AI to perpetuate existing social inequalities.
Okay, so some examples there given by my own digital twin about some of the risks. Talking about generative AI in general and across the board, in terms of the concerns about data quality, whether it embeds biases, gender biases, race biases, the question of fairness, the fact that ChatGPT and other platforms sometimes produce what are called illusions or hallucinations. Basically, they get things wrong.
Yeah.
When it comes to these digital avatars, concerns about deep fakes. So you could get a digital avatar of the president of the US, for example, delivering a message that he or she wouldn't be delivering. So that's a concern. And then the replacement of jobs. And I actually asked myself whether we were going to be replaced. And they said, don't worry, TV anchors are safe because we have charisma. So that's clearly true for you, Anna, and Kriti. There's still a big question mark over me.
Well, I still prefer the real Tom to the digital one, so I think we're safe. I think we're safe there. Tom McKenzie, thank you very much. Tom McKenzie with the latest on those slightly surreal AI developments, talking to himself. Now, coming up, the countdown to the US jobs report. More on that. And what we expect, we will talk to, who else? Mike McKee. He brings the charisma. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, we get the U.S. jobs report today in just a few hours, 8:30 a.m. Eastern Time. The data could show a slowdown in the pace of hiring. Joining us now is Michael McKee, Bloomberg International Economics and Policy Correspondent. Well, could show the slowdown, and that's the hope that it's going to from the markets. Are we going to get there?
Well, it's all relative, of course, because when we're talking about 195,000 jobs is the forecast, that is still a significant number, and it is far above the number that economists say you need to fill the replacements, all the people who come into the labor force each month. So we'll see whether we go down or not. Unemployment expected to tick up just a little bit, and we are going to be watching average hourly earnings because the Fed's going to be watching average hourly earnings. But I tell you, Kriti, if you're a momentum trader and you had 13 up days in a row on a stock, you might want to buy into it.
Yeah.
We've had 13 up months on non-farm payrolls. For 13 months in a row, payrolls have come in higher than the Bloomberg consensus. And so maybe you want to think that is a good bet today. The whisper number on Wall Street, according to Bloomberg's whisper function, is 226. So Wall Street leaning towards the idea that we're going to get a 14th month in a row.
Okay. WIS Go, I think, WHIS, isn't it? The function to find those, Mike. Yeah, incredible run then for that payrolls number. How much weakness do we need to see in the jobs market? Not that anybody in an abstract sense wants to see weakness, but how much will we need to see, or is the Fed thinking we need to see to weigh down on inflation?
Well, they'd like to see the unemployment rate start to rise, and suggesting that the labor market is cooling, and at the same time you might see average hour earnings grow a little bit more slowly, and that's their goal. We're running at a 4.4% average rate each month, annual average, and they'd like to get that down to 3 to 3.5%. But the numbers that have been coming in lately have just shown us very strong labor market remains. We had that JOLTS report that the Fed relies on come in over 10 million again. And of course, ADP this week, even the ISM manufacturing numbers came in stronger than expected for employment. So it looks like the odds are still stacked against the Fed getting what it wants out of the labor market.
Which brings us to the whole concept of a pause, a skip, a gallop, if you will, from the Federal Reserve. Is this one data point really going to make a difference? Doesn't Chairman Powell love to say, look, we are not data, or we are data dependent, and one data point isn't enough to make a call?
Well, the speakers that we have heard from lately, including the presumptive vice chair, he hasn't been confirmed yet, Philip Jefferson, suggest that this data point isn't going to matter, that they still think that they can do at least a skip, not raise in June, and then maybe do it in July if they need to. But if it comes in very strong, especially if wages start to rise, then that could push against that idea. And then, of course, we get the CPI the day before the Fed decision. So today's number and the CPI number will tell us what the Fed is likely to do.
Certainly a lot to digest, and going to be the major macro market mover this morning. Michael McKee, our international economics and policy correspondent, we thank you as always. So that's the macro. Let's look at the micro here. We are watching a few of these stocks in the pre-market. Remember, earnings season still kind of trickling out. Lululemon at the top of that story, higher by about 15% in the pre-market. Their earnings beating estimates. That higher income consumer still buying athleisure, and that is really feeding into their bottom line. So that is good news over at that company. But from retail, let's go to the tech sector. MongoDB, for example, surging on that boost in their EPS forecast. Again, a major tech name here, higher by about 26%. And you are seeing them actually beat their estimates as well. Broadcom is going to be a really interesting story, though, especially when we're talking about this wider slowdown. Those gains, though, overshadowed by the sales slowdown that you're seeing, despite them actually coming out with some good numbers. The share's taking a hit, down about 2%. Anna, and then, of course, Dell Technologies, one of those old guard tech names. Those results are suggesting perhaps there's a bottom in PC sales, but they're not seeing that momentum, that business investment that you would expect. Those shares, again, down just about 3.7% in the pre-market. So a little bit of pain in a little bit of sectors.
Yeah, it's really interesting to watch how this the AI boom is spreading and perhaps limited in some parts of the tech world. So some areas of tech benefiting from it, and others, yes, benefiting, but also feeling the headwinds from the broader tech, broader chip story that we're seeing globally around Chinese growth, perhaps. Now, that is it for Early Edition then, Critty. Surveillance is, of course, ahead. They'll be speaking with Nadia Lovell of UBS, Randy Krosner of the University of Chicago, and Jeff Rosenberg of BlackRock, all joining the team. Lots to discuss as the team gets you ready for that jobs report. Look for that coming a little bit later on today. They'll get you through those numbers and be considering what all of the data means for the Fed, of course. This is Bloomberg.
Middle of a massive exhibition center located on the western suburbs of Shanghai,
where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yang1 yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The economy really hasn't slowed much at all.
We had the Q1 earnings results. Corporate America's actually doing all right.
This is a recession postponed, not canceled.
Even if we have a mild recession, I would still cast that as potentially a soft landing sort of scenario.
We've learned that you have to be cautious. I think we've learned that you have to be tactical in this market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Payrolls Friday, live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive by 0.5%. We'll get to the payrolls talk in just a moment. Your expectation in our survey, 195,000. Before we get there, TK, it's been your story of the week. It's China. The latest reporting from our team here at Bloomberg, according to people familiar with the matter, China is working on a new basket of measures to support the property market.
Right.
TK, that's where the push will be, potentially.
Out early, this is Bloomberg. Bloomberg's reporting this from across our offices in China, that there already is a plan here on property. That's where you go when you're worried about the people and investment in China. It doesn't say much about job formation and the other worries. It moves renminbi right away. Bloomberg put out the story. We get a stronger renminbi coming off of a 7.11 out to right now 7.06 on renminbi. And, you know, we got to get, I'm going to get John to our Sunday evening, their Monday morning. That's when the news breaks.
Property developers anticipating this rallying overnight. The Chinese equity market had a better time of it. And we need to be clear about things right now. Three engines of global growth. China sputtering, Europe struggling relative to some pretty lofty expectations coming into the year, and US resilience. You look at the labour market data so far this week, claims still exceptionally low, vacancies at American employers much higher, the ADP report knocking it out of the park, and Tom, we'll see if we get more of the same in 2 hours, 30 minutes.
We're deep into the month of June, and there is this new idea. I think all of May was about American exceptionalism. Lisa, I think, was talking this up correctly. And our first guest today will talk about what really happens in recession, which is, OMG, we're all going to die at once? No, you roll through a recession, and maybe that's what we're doing now. Parts of America in this jobs report today flat on their back.
Oh, without a doubt. And let's be clear about that as well.
Macy's.
I think it's so important. Dollar General, Macy's. There are others out there as well. It's been a week of contradictions because you compare the fact that we've got some really resilient, robust labour market data, with some manufacturing data, Bramo, which was absolutely terrible.
Bramo's here on a Friday.
Is that what you wanted to
It's
interject
Jobs
with?
Day, yeah.
I will just say this, that when you take a look, I'm not sure where we're going with that, but I will say this. When we take a look at the manufacturing recession and then the resilience in consumer spending, you start to wonder, how much is the U.S. different not only because of tech, but because of a stimulus, because of helicopter money that hasn't worked its way through the system? And at what point are the different whims of the post-pandemic reality and the norms of perhaps YOLO and traveling and going out to eat, when does that sort of, expire and start to create something that's more consistent?
To the celebration in Washington, is Anne Marie with us today? I don't even know.
She will be, yeah.
And the Senate vote and all that, we're maybe less austere than they are. And John, you lived this for your entire life in London. There's a whole idea in the United Kingdom of austerity, and maybe there's a different French austerity or China austerity. And the U.S. says, let's do the Biden stimulus.
It's all relative. I think we've all just been surprised by the resilience story in the United States. Let's get to the price action. A lift in the equity market. Equity futures on the S&P 500 doing better, up by almost 0.5%. Yields a little bit higher as well, up by a single basis point, 361. When you hear a sentence that says China, stimulus somewhere in it, usually you look to commodities, and crude is higher this morning, Lisa. 71 on WTI.
I do wonder, though, how much more could be following with stimulus. We'll be talking about that probably throughout the day. The key data point of the day, 8:30 a.m., May jobs report. There have been 13 straight months of upside surprises. I just want to point that out ahead of a report that is expected to be softer. And yet, the unemployment rate ticking up from 3.4% to 3.5%. Get ready for pro-clutching. Not going to necessarily change the dial all that much. Nevertheless, interesting to see, particularly under the hood dynamics. Today, JP Morgan COO Daniel Pinto and Citi CEO Jane Fraser among speakers at today's Bernstein conference. This comes after yesterday's Goldman Sachs comments about trading being down about 20% and more job cuts, talking about a difficult scenario. Curious to hear whether they're the same kinds of discussions.
I'm really glad you brought this up. There was a change in tone this week. I talked to Srinath Rajan about this on Goldman Sachs and Bloomberg, reporting that there's just a shift in tone.
And talking about how some of their clients are much more pessimistic than they had been previously. I'm watching for that. And this weekend, the OPEC Plus meeting begins in Vienna on Saturday, continues to Sunday. Very curious to see what kind of relationship there is between the United Arab Emirates, Saudi Arabia, how they pair those ideas, how they impose more cuts at a time when a lot of people are lobbying to produce
John,
more.
we should be there.
If the press aren't there, did it happen?
Yeah.
Are we reporting on this?
Well, yes. I think
Javier said, no, we're not.
My understanding is Bloomberg reporters will be in Vienna, perhaps not in the room. I'm sure they will be talking to everybody in the room.
Okay.
But how do you cover something where they aggressively do not want you to cover it, want to massage the message? It's going to be an existential question for journalists.
That cartel is like the leakiest thing in the world.
Yes.
Seriously, even if you say journalists out
No
loud
pun
in there.
intended.
I mean, you speak to people who attend that conference, that get-together, that meeting, whatever you want to call it. It is the leakiest thing ever.
The whole purpose is to message something, right? It's to basically jawbone prices into a certain direction and give some sort of appearance of unity. So it is all about the message. Of course, it's going to be leaky with people trying to lobby for their message to get
On
out.
a microeconomic basis, a cartel is nothing but jawboning. I mean, by definition, that's what a cartel is. It's a verbal statement that doesn't have any reality in economics. I mean,
some people just want to be heard, though, Bramo. It's not just about trying to manage prices. It's about ego. They like to be in touch with journalists. But, you know, people like that. Some people are like that.
Yeah.
That's why you get those leaks. Some people like to talk to journalists. They just like to be heard.
John
they like an audience.
Well, if anyone wants to be heard, this is going to be a public service announcement. Feel free to give a call.
Steve Whiting joins us now, Chief Investment Strategist and Chief Economist over at Citi Global Wealth. If they scroll a little bit, there we go. Steve, I'd forgotten your title. It's great to have you with us, Steve. Let's just start with Fed policy. Coming up a little bit later, we get payrolls. If we de-emphasize the importance of payrolls a little bit later, given the guidance we've had from Fed officials earlier this week?
Perhaps not. I mean, there's been so much other news to consider. When you think about the Fed, they've done an average of 50 basis points for 10 consecutive meetings. Now, by the time inflation is down exactly to where they want, and their price measure, the one that doesn't move as much, the PCE deflator, could be another 10 meetings. But they can't go on tightening 50 basis points every single meeting without getting a policy that would ultimately crash the economy. So they've set us up here, particularly while we were having all of this debt ceiling uncertainty, which we couldn't ever be certain what the market effects would be, what the effects in Washington would be, to at least skip a meeting and just see. But now we run into the payrolls data. And again, it could make it a little difficult, again, if it's a big surprise one way or the other.
Steve, you bring prodigious economics to the strategy part of the game. I love in your research note, you talk about a rolling recession. is a general statement, and I'm thinking NBER, but it can be as a general statement as well. Are we going to have a rolling recession that will actually affect the glory sectors like technology? Can we have a recession that rolls to NVIDIA?
Well, look, it's different every time in terms of composition. If this was, the year 2000 into 2021, then the answer would be yes. But I would probably say no in this case. I think that you're going to see growth in AI has been really constrained entirely to building the infrastructure of AI. Now, whether that's gone too far in a particular stock or not is one thing, but I think it'll broaden out its impact in coming years. And it's really not at the heart of what's going on in any of the slower sectors of the economy. You said it just before. The ISM data shows that manufacturing and trade around the world is contracting. It's in recession. Some industries didn't quite have the downturn or the upturn, like autos. The multifamily apartment sector is something that I think everybody should be looking at and saying their recession hasn't happened yet, but it's coming. It'll be like single family housing, which is already having, in some respects, a bottoming in sales. Declines are already happening in production. It's allowing us, while we still have strengthened services from these COVID distortions that you just spoke about, it's allowing us to actually work off inventories. So the rolling recessions are having the intended effect. It's holding the American economy's growth rate down, but it's not crashing it. And in fact, I think that's what we're seeing around the world, of more or less listless growth rather than a collapse.
Did you see anything during the first 6 months of this year that made you materially change your allocation heading into the second half?
Well, we did some things, to be quite contrary in some respects. Defensive investments, really, again, you can do this in any asset class. For example, we were overweight pharmaceuticals. They fell 2% last year. Global equities down about 20%. We still love the industry. We don't think that it's overvalued, but we got about as much defense as we could out of that. So what we did is we reallocated to some more offensive investments. These are around the world. You could take a look at Brazilian equities, or 7 times earnings, 7% dividend yield, 9% real interest rates as inflation is coming down. So a currency that's very weak. You can see, again, how China may not be the only source of growth in Asia. You can broaden this out. So we've allocated about 4% more to non-U.S. equities. And I would say that, again, there's more to do here. We're actually seeing the dislocations of a recession in some parts of our equity markets. So, again, we're not exactly bullish. We're underweight equities. But a lot of things that actually occur in recessions that clear the decks are, in fact, happening.
Certainly seeing that in manufacturing right now. Steve, thank you, sir. Steve Whiting there of Citi. If you take a look at the ISM manufacturing that came out yesterday, below 50, you've got this dividing line between expansion and contraction. That line is 50. We've been below 50 for 7 consecutive months. That's the longest streak, Tom, going back to, guess when, 2009.
Yeah,
2009. It's pretty terrible, the read on manufacturing right now.
On a Friday, this is really important as we all read into the weekend to recalibrate for June. And part of this is this bifurcation in China, in the U.S., maybe in Europe as well, between manufacturing and a consumer service sector, almost financial restaurant boom that's in there. John, I think we've got to reframe in the jobs report here the excitement in the equity market. I didn't realize this. The VIX, 15.45, I'm sure off the enthusiasm in Washington. John, 5:10 a.m. today. This is before I got in. Round up the Standard & Poor's 500 to 4,300. We went over 4,250 on futures. So, I think any optimist would round it up. 4,300 coming.
Ultimate contrarian trade right now. Michael Hartnett, Bank of America. Buy the Hang Seng, sell AI on surprise June China stimulus, bullish commodities, EM, resources, and banks. We'll pick up on that note a little bit later. Equities right now up 0.5%. From New York on this Payrolls Friday, your estimate 195,000, your number about 2 hours and 18 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo.
Global food costs fell in May, dropping to the lowest level in 2 years and reviving hopes that inflation on supermarket shelves will start to ease. The United Nations Index of Food Commodity Prices fell 2.6 in May as declines in grains, vegetable oil, and dairy offset gains in sugar and meat costs. The gauge of prices for internationally traded agricultural commodities has fallen 22% from its peak last year following Russia's invasion of Ukraine. In Singapore, Pentagon Chief Lloyd Austin and his Chinese counterpart Li Shangfu are among more than 600 military leaders, policymakers, and analysts from 40 nations taking part in the annual Shangri-La Dialogue. The U.S. says Beijing has ruled out a meeting between the two military chiefs, with China frustrated the Biden administration hasn't removed sanctions the U.S. placed on Li in 2018. The Pentagon is set to buy Starlink satellite communications terminals and services from Elon Musk's SpaceX for use by the Ukrainian military. The U.S. has praised the role that the terminals have played in Kyiv's war effort, seeing them as vital for the country's defense. And Rishi Sunak's administration has refused a demand from the UK's COVID-19 inquiry to hand over former Prime Minister Boris Johnson's WhatsApp messages and pandemic diaries. The government's cabinet office says it's filing for a judicial review into the request for the documents. The move sets up a legal battle that risks amplifying accusations of a cover-up. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
DOJ or other authorities.
Could face bigger challenges.
Britain's next.
It was going to keep Green World Cup. This is a three.
As the economic picture does.
The BOK is getting ready to make this decision.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. So far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jake Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May jobs report, today on Bloomberg Television and Radio.
This demanded a bipartisan solution. We knew we'd need to come together for a solution like the one that passed tonight. And so I'm happy to stand here passing this critical legislation to support our families, preserve vital programs, and most importantly, avoid catastrophic default.
63 to 36, Senate Majority Leader Chuck Schumer, the debt ceiling bill passing the Senate with ease. It's onto the president's desk. This is what the president had to say. No one gets everything they want in a negotiation, but make no mistake, this bipartisan agreement is a big win for our economy and the American people. I believe we'll hear from the President of the United States a little bit later on this evening, Tom, when he addresses the nation.
It's gonna be interesting. Of course, he had this fall yesterday at the Air Force Academy. I watched the video carefully, and he made a joke about it. He got sandbagged. He did. It was sitting there, just like on a stage. I think I saw Francine at Chernobyl fall over a sandbag once, and it's the same thing. These little things are down there on the floor, and they can bite you.
Except it's not the same thing, because this individual is 80 years old, and every time we see any kind of incident like this, a lot of people, Tom, are going to be saying the same thing.
I was the same way.
Yeah.
Absolutely. No question about it. You're waking up to, can we say crisis over? Is this the first morning?
Unless the president surprises us and says, no, I'm not signing it. No, I think we can say crisis is over.
Let us recalibrate on a Friday and move forward, and we're going to try to avoid the silliness of the political season. You can do that with Daniel Clifton. To say he's partnered head of policy research at Strategas doesn't describe that when he started writing notes years ago, they came out of the screen, came off the internet with terse facts about what's going on. The fact that has changed Dan Clifton is the guy from Bakersfield. Here's a kid out of Bakersfield. He was a firefighter. He worked his way through one of the Cal State systems. Kevin McCarthy's been underestimated by everybody from day one. You write this morning on the underestimation of the speaker. How big a victory is it for Kevin McCarthy?
Well, it's big. It's not the biggest. He still has problems in his caucus, but this is big. He earned his speakership over the last 3 months. This was a president who said, I will not negotiate on the debt ceiling. I believe the president was very clear about that based on his own experiences, which you remember very clearly, Tom, from 2011 when he was vice president. And the speaker unified his caucus, passed a bill out of the House of Representatives, forced a negotiation, and got $1 trillion of spending cuts. Did they get everything they wanted? Absolutely not. And that's evident by the vote totals that Jonathan just reported on. More Democrats voted for the debt ceiling bill in the House and Senate than Republicans did. But this could have gone far worse. The brinksmanship could have been far more intense if McCarthy wasn't able to unify his caucus the way he did. And he delivered 2/3 of Republicans in support of raising the debt ceiling. It's a big, big win. And he showed that he can do this better than previous speakers.
To stagger forward to November 2024, is the middle changed? I mean, obviously there's going to be a polarity primary on both sides, but did the respect for the middle change within our political class?
No, I think that we always have a middle. It's just the extremes tend to amplify that. Let me give you one example. We've had 9 federal elections since the financial crisis, and the voters of this country have removed the party in power in 8 of those 9 elections. So that's somebody in the middle moving between both sides back and forth. And I do think that that middle does hold. It's just a really ugly process here. The process of getting legislation passed, but it got done on a bipartisan basis, and how we select our presidents moving forward. And so I think this is going to be the wildest election of our lifetime. It's going to make 2016 and 2008, which were just classic, amazing elections, be very, very different this time. But we have a lot of challenges, Tom, before we get there. We're going to have to settle how we're going to do the defense spending budget, even though we have a top-line spending number. We're going to have to figure out how we're going to respond to China with these new budget limits in place. And the Treasury is going to be very, very constrained in how they are raising the debt with the rising debt service cost in the first 35 years. So it's easy to pull forward and say, okay, we got this big crisis out of the way. What's going to happen in 24? But we're going to have some serious domestic and international challenges before we get there, and governing is going to be needed. And the biggest implication from this debt ceiling deal is that there's now just a smidge of trust between Kevin McCarthy and Joe Biden, something that did not exist as late as 3 weeks ago.
I wanted to pick up, Dan, on this idea of the tax constraint, of how much revenue they can raise, the sort of fiscal drag that starts to take hold. I woke up this morning very excited that maybe we could stop talking about the debt ceiling debate and that perhaps we've moved on. But you point out that once debt servicing costs exceed 14% of GDP, I believe, you end up with this real pressure. Can you talk about what that means economically?
So if you talk to anybody who's been in markets or Washington for 35 years, they're like, deficits really don't matter. There's a lot of complaining about it. But this is the first time our debt servicing cost is rising in 35 years. We measure that by net interest costs as a percent of tax revenue. Interest costs are surging because of higher interest rates, and tax revenues are declining. And so what the debt ceiling really represented, Lisa, was the first course in a larger period of austerity. And how did we reach that conclusion? We went back 80 years and we looked at whether the U.S. was in a period of austerity or stimulus, and really the defining factors that debt servicing costs. Once you hit over 14%, the bond market starts to put pressure on policymakers and it forces austerity. I mean, we raised taxes 6 years in a row in the early 80s under Ronald Reagan while we had that 14% interest cost, and it was higher. And so we'll hit it in the next couple of months. And that's why you're seeing Treasury so constrained on its ability to raise debt. I mean, they were raising cash management bills this week at 6.15%. Sure, the debt ceiling added a little premium to that, but come on, at 6% for 3-day cash management bill, it's a pretty big problem. And I think that that's going to be a bigger issue. So Treasury's got to reload TGA, the Treasury General Account. They're going to try and do it out of the reverse repos, Lisa. And that's going to be really hard to do because that reverse repo rate is pretty high. There's no duration risk. And if they can't get it out of reverse repos, it's going to come out of bank reserves. And that means that there's going to be less liquidity. And so we've been arguing throughout the whole debt ceiling debate is that stocks can rally into the debt ceiling debate because there will be massive liquidity being pumped into the system. Once the debt ceiling gets raised, that liquidity may come out, and there poses some risk for financial markets in the second half of the year.
A lot of people focused on the potential for that. Dan, I just want to finish on the election next year. And just a word on the front runners at the moment. Can you think of a time when such a large chunk of the middle of this country is facing the prospect of two candidates facing each other again, that they just don't want them to run?
Great question. I spent 11 weeks on the road into the last election, and every time I'd say Trump versus Biden, no matter who that person was, they gave me a funny look, right? And if Republican, Democrat, old, young, it didn't really matter. And so their support may be a little bit softer than what you would see in the polls because of high name ID. We're going to have a very spirited debate in the Republican primary. I keep an eye on Glenn Youngkin, the governor of Virginia, seems to be indicating that he wants to get in. Ron DeSantis has won a landslide in Florida. So as he gets used to the rhythm of the campaign, I think he's going to be a formidable candidate. And I keep an eye on Tim Scott. Then on the Democratic side, I would just keep an eye on RFK being a Pat Buchanan-like candidate, what Pat Buchanan did to George Herbert Walker Bush. Joe Biden wants to be the nominee. He will be the nominee. I'm not saying that in any way.
Sure.
But Pat Buchanan dented George Herbert Walker Bush in '92, which ultimately led to Bill Clinton's victory. And there could be some concern about that as we get deeper into the race. So I think we're going to have a very spirited debate. Candidates are going to be tested. And, again, the process isn't very pretty, but I think the outcome will produce one that may be a little bit different than the consensus expects right now.
Interesting. Dan, thanks for that. Dan Clifton there, of Strategas Research Partners. Hear more and more about that. If you don't see that Governor DeSantis bump anytime soon, you start hearing more and more about Governor Youngkin stepping in. TK, is this the best this country can do? I hear that question being asked a lot. Reminds me of 2019 over in the UK, Corbyn, Johnson, same thing. Same conversation. Is this the best this country can do?
Exactly. It's the quality of the people. And one thing I will say is there's an eclectic group, to say the least.
Futures right now, positive. Talk of China stimulus. We'll pick up on that conversation next.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Payroll's just around the corner. Equities higher. Welcome to the program. Before we get to the weekend, let's deal with this. Some data just ahead of us. Equities up by 0.5% on the S&P 500. On the Nasdaq, up by 0.5% as well. A lift in the equity market. If you get to the bond market, yields look like this. 2-year, 10-year, 30-year, 2-year. Just a bit higher by not even a basis point. 434.72. Looking at the FX market, only one thing to look at really, and that's China crosses. Right now, dollar CNH, a breakdown there. So that's a stronger Chinese currency, Tom, off the back of speculation and reporting here at Bloomberg that we could get some stimulus around the property market.
About an hour ago, Bloomberg reports that we're going to see property market stimulus, which goes right to the heart of the middle class. There, I'd also know, John, just general dollar weakness. I mean, are we going to see Euro 108? Did we expect that 24 hours ago? I'm not so sure. 107.71. An euro. The equity market lift, John, I wonder if we get a certain wage dynamic, a certain non-farm payroll dynamic today, if it's melt up Friday. I'm not there yet. I'm not predicting it.
Sure.
But I'm looking at a tape that's got some bid to it.
I'm thinking of Andrew Honhorst of Citi, who set the bar pretty low coming into this week for a hike from the Federal Reserve in June. He said 200K on payrolls, 0.4% on core CPI. They'd go. He acknowledged yesterday in his most recent note when he published that the timing of that is now uncertain. He still thinks we get another 225 basis point hikes, something like 50 over the coming meetings. But ultimately, there's a real feeling after the Fed speak of this week that these Federal Reserve officials have de-emphasized the near-term incoming information. Payrolls today, CPI ahead of the next meeting. So I just wonder how big today's got to be just to reintroduce the idea, TK, that they could make a move this month.
I'm sorry, the inflation data is going to be a big deal coming up. What
Agreed.
date is that?
The day before the meeting, June 13th. Right. So they're going to the quiet period this weekend. Yeah. For those of you interested in some of the estimates out there, the median estimate in our survey is 195,000. There's a big range. There always is. It's not as big as it was in a pandemic year, so let's be clear about that. The high estimate, 252. The low, about 100K. These are the big estimates on the street right now on Wall Street. JP Morgan, bottom of the pack, 150,000. Wells Fargo, top of the pack, 210,000 TK. They look for something like 210 a little bit later. You can see there, though, Citi, 200K, B of A, 200K. And let's be clear, 3.4% unemployment, even if you think that goes to 3.5 and churning out 200,000 jobs a month, that ain't bad.
It's not bad. Even the Ferroli JP Morgan 150 statistic would be not bad in a normal economy. Sarah House joins. She's senior economist at Wells Fargo. Sarah, in the zeitgeist this morning is a whole thrust that, yes, we're creating jobs, but they're low-paying jobs, many of them taken by new immigrants, different kinds of people than what America expects. The 200,000 big number you see this morning, what kind of jobs are those?
Yeah, so I think one thing that's important to note is in terms of the job creation that we've seen recently and what we expect here in the near term is that we're continuing to see outsized gains in areas like leisure and hospitality that have more scope for catch-up. And so that's important given that this is the lowest paying major industry that we see. And on the flip side, where we're seeing some more of the softness, it's in areas like information, professional and business services, financial services. So I think you are seeing a bit of a rotation in terms of that job quality that the American economy is creating right now.
In the partition of this jobs report, there is an optimism that will endure in this recession, and there's an idea of rolling recession or complete recession, whatever. Where do you fit into that?
Yeah, so we think that overall the U.S. economy will enter into recession, and it's probably useful to put some definitions around that since I think the people's views of recessions have gotten a little muddled. But we do expect a contraction, not just in GDP, but consumer spending, as well as some job losses. And so we're looking for that contraction to happen, probably around the fourth quarter of this year, maybe spilling over into the early part of next year. But I think when we step back and we take into account that we haven't seen the full effects of Fed tightening, and ultimately we do need to see demand come down to get inflation back to 2% on a sustained basis, we think it's going to take a contraction in overall activity.
Just to John's point earlier, how high is the bar for the Fed to hike rates, given that people are expecting a robust labor market? We got the JOLT survey, and yet Fed rhetoric really changed the equation this week.
Yeah, so in terms of the Fed going again in June, the bar is certainly a lot higher than it was at the start of the week, and it's not because of the data. So a lot of the data is still coming pretty strong this week, but it is because of that Fed speak, and what the Fed is telling us is what's going to be a more cautious reaction to that data. And so I think in terms of today's numbers really changing that equation, I think you'd have to see probably at least 250,000 in terms of payrolls, maybe even higher, to get that 3-month moving average up. So just really see that trend accelerate. And it's also going to have to probably be corroborated by more strength coming out of wage growth than what's expected as well, and a still very low unemployment rate signaling that jobs market is still incredibly tight.
Have we abandoned data dependency simply because it's too complicated given all of the differing kinds of signals out there?
I think we have to some extent. So I think it's in some ways the timing of this Fed pause, skip, whatever you want to call it, is pretty interesting when you consider the fact that if you look at the Bloomberg Economic Surprise Index for the U.S., it's at an 18-month high right now. And so we've actually seen the data come in much stronger than what was expected, and yet here we are talking about a hold in June. So while the Fed's telling us they are still data dependent, I think clearly it's not, every tick of the data, but it still seems to be somewhat of a strange time to kind of back off that data side and perhaps hold rates here in June.
Sarah, take the vector of wage growth and the vector of inflation now and tell me where I'm going to see an actual inflation-adjusted real wage growth. Is it this year or next year?
Yeah, so I think we're probably getting close to it this year, and a big part of that is what's happening in terms of the commodity space. So I think the fact that you're finally seeing some outright deflation in food, we're certainly going to see a big drag from energy prices here in the next CPI report. And so I think near term you could get real wage growth, but I think in terms of that, how much it persists, I think that's going to be a closer call, and we're still probably going to be looking at only modestly to roughly flat real average hourly earnings growth as we look into probably 2024.
Mike McKee emails in. He goes, ask Sarah what I should look for beneath the headline data. What is the oddity you're going to be looking for immediately within the report at 8:30?
Well, I think one big thing we still need to be very focused on is what's happening on the labor supply front. So we have seen labor demand trend down, still pretty strong, but I think in terms of the outright path of payroll growth and how many jobs we can continue to add, that still depends heavily on what's happening on the supply front. So we've had a pretty good run in terms of labor force participation, labor force growth over the past 6 months or so, either flat or higher. So can we see that continue? Because I think that suggests that the labor market still might have a little bit more more legs, and I think that could also help the broader economy, given what that means in terms of consumer spending.
We're speaking with Sarah House of Wells Fargo, and I have to wonder, before we let you go, on a broader level, a lot of people are looking tick by tick and seeing a slow sort of deceleration of the economy. You can argue over how quickly, you can argue over what the Fed's response is going to be. But a lot of it is becoming somewhat predictable in the fog that we're all in. And I'm wondering what tail risks you see percolating out there, not necessarily probabilities that are likely, but things that are keeping you up at night, whether it's the multifamily housing that Steve Whiting was talking about or commercial real estate.
Well, I think in some ways we're still worried about some of the bank stress. So just given that, even if the Fed doesn't raise rates from here, it's a continued squeeze. And so do you get perhaps a more discrete event which does introduce more risk and uncertainty, and you get more of an abrupt shift in some of the activity momentum because of that? I think that's one thing that we're still thinking a lot about.
Sarah House of Wells Fargo. Sarah, thank you. Going into the quiet period for the Federal Reserve, looking out for a little bit more Fed speak and a touch more data as well. 8:30 Eastern time, payrolls expected to come in somewhere around 200K in our latest survey, 195. Dare I say the Fed's done a decent job of communicating this week. Governor Jefferson, I think, leading the pack, trying to get everyone together and talk about, Tom, this skip. Not a pause.
Yeah, the skip pause thing, we started the week on that silliness, and I think it's calmed down a little bit. I think the reason it's calmed down is we're to the data. And I mean, how many times have we gasped when Makia sat next to us and we've looked at the data come out and it's like, oops, it's not what anybody expected.
We've talked a lot
Why
about
would
this.
today be different?
Makia came out with the stat. Lisa mentioned it a little bit earlier as well. It isn't since last April 2022, when we got the March payrolls report, on the day when we had a downside surprise for payrolls. And Lisa, that's been the theme. You heard Sarah mention the surprise index. Just where is the data coming in relative to expectations? Upside surprise, upside surprise, upside surprise.
The pause versus skip thing really has made me think about the economics profession generally and how it usually looks at a longer set of data over a historical period. It doesn't work on a month-to-month kind of basis in a post-pandemic economy that's still reeling with these distortions. So what we're hearing right now from the Fed is pause, literally, stop it for a second. Let's try to understand not only where we are economically, but also what our policy is doing. In that sphere, investors don't have the luxury of also pausing, of also skipping, of also not doing anything. So what do you do? How do you arrange when you cannot necessarily get an edge on whether we're going to get a recession, of how deep it's going to be, of which data is going to be most important?
Might get some healthy dissent, Tom, in the next couple of weeks. That would be interesting. Finally, the committee, and you can feel the committee splintering, the likes of Mester,
Goolsbee,
Bullard. Oh, well, Goolsbee certainly doesn't want to move. I'm sure if you listen to Goolsbee right now, I think he's ready just to commit to the end of it.
Yeah.
Pause, we're done.
Can I talk about a disinflation?
Your disagreement face is so loud, it's unbelievable.
Is there the Bramo
Honestly,
disagreement
every
face?
time anyone speaks, it's like I'm ready to disagree.
No, I'm not. I was just trading by my father.
It's like
I will just
reflexive. Go on.
No, it's not reflexive. I'm listening to what you're saying, and I think that there could be dissent. I'm guessing there probably won't be, and I'll tell you why. Because right now, I don't hear many people saying that there still is this risk of runaway inflation. The hyperinflation kinds of arguments have kind of faded away a little bit. We're clearly seeing the peak of inflation. And so from that perspective, the idea of just taking a break is probably going to gain more traction.
Oh, they can find consensus on that. I said it verbatim yesterday. There are a couple of things they can find consensus on in the committee at the moment. One is no cuts, and the other is we can wait. They can find some consensus there, but there are others who think, based on the information, that we're not sufficiently restrictive, and that will be exacerbated if we get a hot print in about an hour and 50 minutes, and again if we get a hot CPI right before the meeting.
Can I ask a question?
Sure.
Is corn wheat in the United Kingdom? Is wheat corn?
What
do you call wheat?
Are we talking about this?
Because the disinflation story, wheat is down 57% in the United States from a year ago peak. It's only down 29% in the United Kingdom if corn is wheat in the United Kingdom.
Honestly, this show's so random.
Is it corn?
I've got no idea.
That's why they watch.
I've got no idea. Is it?
Well, you have Weetabix. What are those little things?
Weetabix.
Weetabix.
Yeah.
So do you say, like, commodity exchange, do you say wheat?
I think we say wheat and corn.
Okay.
I'm not a farmer.
I don't know.
Sarah Wolf of Morgan Stanley, 7:30.
Corn.
So that's
corn
about
laws.
50 minutes from now. The corn laws are something, yeah.
Thank you.
Yeah. Free trade, all of that. Adam Smith. I remember all that stuff, Tom.
Yeah.
Yeah, I was there with you in the Victorian era. This is Bloomberg.
What just happened? Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, Ukraine's air defense says 15 cruise missiles and at least 21 drones were shot down in the Kyiv region today. Now, Ukraine's capital has been attacked by Russia from air on each of the past 6 nights. No casualties were immediately reported after at least 3 people, including a child, were killed in Thursday's barrage. Now, meanwhile, drone attacks have been reported across a widening portion of Russia. Bloomberg has learned Turkish President Recep Tayyip Erdogan will tap Mehmet Simsek as his new Treasury and Finance Minister. And Simsek is an advocate of conventional economics. Now, supporters say his appointment will likely shore up market confidence. Simsek is set to be in charge of all Turkey's economic policies in the new cabinet. Erdogan won re-election on Sunday, extending his more than 2 decades in power. And Jamie Dimon will visit Taiwan after wrapping up his high-profile trip to China. The stop-off by the J.P. Morgan CEO comes at a time of heightened tensions between Beijing and Washington. LVMH CEO Bernard Arnault, meanwhile, has become the latest big company boss to announce plans to visit China as Tesla CEO Elon Musk returns from his whirlwind tour of the country. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The United States does not seek conflict or confrontation with China. China and the United States should be able to work together where we can to solve some global challenges like climate. But we are prepared for vigorous competition. We will stand up for our interests, for our friends, and for our values.
That was the President of the United States on China, I think before tripping over shortly after that. We are told the President is okay. He joked after getting off the helicopter at the White House, Tom.
But you were right before.
What's that?
You were correct. You said it doesn't matter. At his age, everybody's watching.
I could see it on the news yesterday
Same
evening.
with President Trump.
This is the problem, TK. Can't get away from it. And we've said this a few times. Got to get away from just saying he's 80 years old. There's a lot of people who think he's an old 80 years old. And that's going to be a concern for a lot of people going into the election next year. Mentioned China there. The reporting for the team here at Bloomberg that China is working on a new basket of measures to support the property market, aka stimulus in the minds of a lot of people. And you can see the strength of the Chinese currency coming through a little bit early this morning. This all taking place, I'd say, Tom, about 2 hours ago.
If you stand in Shanghai or you stand in Beijing and you look around, there are properties, and many of them are residential, and many of them are the only outlet for wealth creation, or at least supposed wealth creation, in China. Someone with firsthand experience on this Bloomberg News story is Tom McKenzie. He joins us in London. Yeoman's duty, way past, John, way past overtime. McKenzie
It
clocking
should be
overtime.
the start of this weekend, shouldn't it?
Overtime today in London. Tom, thank you on a Friday for joining us. Tom, you've lived this in real time. Explain property in China. Is it the only outlet for the middle class to provide for a future?
Well, Tom, the pendulum has swung. When I arrived in 2016 in China, there were banners being put up, Xi Jinping saying houses are for living in, not for speculating, because the run-up in property prices was red hot, and they were putting in place restrictions to ensure you couldn't buy multiple properties, which historically is something people have done. Why? Precisely because of your point, the majority of household income, or at least savings and wealth, is stored in property because of the difficulties, the risks of investing in the equity markets, and of course getting that money offshore. It accounts by some measures, the property sector, for about 20% of China's GDP. And the announcements today, broken by Bloomberg News, around additional measures to support this now beleaguered property sector really speak to the urgency. So they're allowing people to buy more properties in certain cities. They're easing some of those restrictions, making it lower in terms of the down payment you have to put, and in terms of the commissioner fees as well that some of these agents charge. They're putting a cap on those. That's another measure that the government has used to try and put a cap historically on house prices. Now house prices are down. They continue to be lower. That is a major problem for the developers and that economy.
Well, you mentioned the developers. Are they putting in this legislation, and maybe we'll see it, folks, Sunday evening, New York time. Look for our Asian coverage in the Monday morning of Sunday, 7 p.m. New York time. Tom McKenzie, are they doing this for Evergrande? Is the arc troubled developer, or are they doing this for a couple out to the west in Chengdu looking at pandas?
Well, Wonder and Evergrande are two developers that are firmly in focus, clearly, for policymakers in Beijing. So the total, there's potentially debt default or debt that's at risk that is approximate to about 12% of China's GDP. Property debt that is at risk of default, equivalent to about 12% of Chinese GDP, according to some metrics. And those two developers are in the spotlight, certainly. If they can't shift properties, then the payments that they're making, the inability to tap the markets, and they are paying about 20%, by the way, if they do try and tap the markets, that becomes that much more difficult. If they can't sell properties, they're not buying land. If they're not buying land, then local governments can't fund the support that they need for this economy, because local governments in China, Tom, as you know, depend on land sales in order to drive their revenues to be able to fund the infrastructure projects that Beijing wants to see right now.
Tom, how much is this about supporting the economy and fueling growth, and how much is this just avoiding a massive, massive pitfall?
Well, it's a really fine line to thread. According to Goldman Sachs, total debt, China's total government debt, and that includes the off-balance sheet local government financing vehicles, for example, the shadow banks, it's about $23 trillion. That's the estimate from Goldman Sachs. You're talking, what, 30 trillion in the US for equivalence? So they want to try and engineer that support for the developers. They want to help in terms of the refinancing and access to liquidity. They want to be able to support households and consumers to be able to go out there and have the confidence to buy these properties, because, again, it has that loop back to local governments. But what people are saying as well, the likes of Rhodium Group, are what you'd really need is a restructuring plan for the debt for these developers, and so far that hasn't been forthcoming. The other point is you're looking again at plus 20% unemployment for China's youth. It is remarkable. That's a record number, and that's the official number. People I speak to on the ground say it's far likely higher than that. That is holding back the demand for property as well. So this cycle is something they're trying to break.
And there's probably a whole lot more to it. Is this the end of stimulus, or is this basically the opening salvo in a series of steps that are expected from the Chinese Communist Party?
I mean, given the fact that we saw Chinese stocks, getting close to a bear market earlier this week, that was clearly something that strategists were calling out for, saying, look, you can cut the benchmark rates, you can go through with more reserve requirement ratio cuts for the banking sector. There isn't an inflation problem in China. They do have dry powder, but clearly, and this is something you're nodding to, obviously, Lisa, is the concern, the historic concern that Beijing's policymakers have about getting back to a place where there is over-exuberance in terms of leverage. They've done some work on that front. They don't want to unwind all of it.
Tom, what are you looking for Sunday evening, New York time? Are you like me, where you just say, look, they got to put some news out, and the way to do it is to start the week strong?
Well, out of China, what are we going to be watching? I mean, look, there was an uptick in the equities, of course, today on the back of confidence that maybe you're not going to get the rate hikes coming through from the Fed, that maybe there was a bit of buying because the valuations are looking so cheap in terms of Chinese equities. We'll see if that can be maintained. Those equities listed in Hong Kong. The yuan, as you're saying, seeing a bit of strength. We'll watch for any policy. They are tempted, Chinese policymakers, to push through policy over the weekend. So you're right for that as well. Are they going to come through with any additional supportive measures? Again, this is something that people on the ground are calling out for. People who have exposure to Chinese stocks want to see more support coming through.
Wasn't there a rate cut on Christmas Day a long time ago?
Yes,
do you remember that? How many years ago was that, Tom? Decades ago, I think.
I would say about a decade ago.
Wow. Tom McKenzie, rate cuts on Christmas, TK.
Yeah.
Gifts for the equity market bulls.
That's what you do. And I mean, McKenzie...
Cut rates on Christmas.
Yeah, but the idea is you do it when nobody's looking. I mean, we saw that last Friday. I can't remember what the news item was. Friday, somebody snuck something out, Memorial Day weekend. Nobody will see it. That's what they do.
You've been waiting for this. We've been questioning it. When it comes to policy out of China, I'm not sure they care about the PMI being above 50, below 50.
Yeah.
Tom, what's the long-term goal here? Is it the nervousness around youth unemployment? What is it?
The answer is sitting in Beijing with a pounding headache because of the pollution, doing a conference with BNP Paribas. And I'm sitting there with 500 people in the room, and they've told me, be careful what you say for all these... Bloomberg has told me, be careful what you say for all the sensitive reasons. And I'm there with the top thinkers for BNP Paribas with their 100 years of heritage in China. And guess what they said? The PMI doesn't matter.
Yeah.
That's basically what the top bank in France said with all of the emotion of the French district in Shanghai.
Bramo, what do you suppose it is that's pushing China potentially over the line here to do something about property?
Is it just simply because there is so much speculation about a decline? I don't know. I mean, honestly, how much is this a shift that we've seen in terms of CEOs of the U.S. and other places going to China, possibly trying to open up a little bit more because of some of the situations in the economy?
This week, Elon Musk, Jamie Dimon, and Jamie's going where now?
Taiwan.
What do you make of that?
I don't know. 1-800-DIAL-JAMIE when it comes to the political sphere. He's definitely shown his interest in, public office.
Do you think that's real? We're hearing more and more about that.
I can't imagine that it's not. If he goes to China, has this real neutral tone, and then goes to Taiwan in equal measure, what's this about? Is he looking for chips for JP Morgan?
TK?
I think anything Mr. Dimon does is scrutinized. He could go out for a cup of coffee on Fifth Avenue at the Blue Note Cafe. People would be like, what does it mean?
Well, this comes after our conversation this week with him, and he indicated that he would like to serve his country. Didn't indicate in what capacity.
In his annual report, in Lisa's defense, every year there's a theme to the annual report. One year was hard work. Guess what? This year was right where Lisa's talking. It was on geopolitics.
And then Bill Ackman, political expert, came out and talked up the potential of Jamie Dimon running for president.
Not sure that really helped the cause,
I mean,
but
if
I do think that was notable.
if Jamie Dimon was having a cup of coffee with Bill Ackman next to the Guggenheim at the Bluestone Cafe, guess what? It'd make news.
Good cafe, by the way. Up in the 90s on 5th. Yeah, got a lot of time for that.
Yeah.
Next door to the church.
Yeah, it's usually, I try to get down into the 70s sometime during the weekend, but that's amazing as far as I get.
I'm with you. That's a great place, that
It's
is.
a good place. Yeah.
Sort of like inside the church, to the sun.
The avocado's a religious experience.
Nice in the summer, too. Got to get there early, though, to get a seat.
Got to get there early.
Get
Big
there
tourist.
so early.
Yeah, it's on every tourist
Kind of like
bucket
spills
list.
out into the sidewalk, onto the road. And
You been to the Guggenheim?
No.
Oh, you should go.
Walk past it a lot.
It's got a real soul.
Has it?
Yes.
Doesn't look like it's got one.
It's got a soul.
All right, I'll check it out. Future's positive from New York. This is Bloomberg.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with their head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The economy really hasn't slowed much at all.
We had the Q1 earnings results. Corporate America's actually doing all right.
This is a recession postponed, not canceled.
Even if we have a mild recession, I would still cast that as potentially a soft landing sort of scenario.
We've learned that you have to be cautious. I think we've learned that you have to be tactical in this market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Looking to get you to the weekend, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market positive by 0.5% on the S&P 500. Payrolls 90 minutes away. In our Bloomberg survey, the estimate 195,000. Lots of talks about the potential for stimulus out of China. Our latest reporting, TK, indicating under consideration, weighing options around the property market.
The set of good news is life goes on a Friday morning. We wake up to the Senate solution in Washington. We wake up to the maybe Beijing solution in China. Are we going to wake up to a jobs report that changes Fed policy going to June 14th? Frankly, either way, I'm not sure which way it'll cut in the jobs report.
I think Lisa's been nailing this after the Fed speak of this week so far, Lisa. Have they de-emphasised the importance of this payrolls print, just with regards to what they do and don't do in June?
It seems like they want to pause, skip, whatever you want to call it, and it's not really going to make a difference unless there's some sort of blowout number. Of course, we're going to be saying something completely different probably at 8:30 a.m. today. If we do get something different, it's a tough moment when there is so much conflicting data, and this is something that a lot of traders are having trouble with.
CPI after this one as well. I do wonder, Andrew Honhorst, the City, we've talked about him a few times. He said 200K, 0.4% core CPI, maybe at the start of the week, Bramo. Now, after Governor Jefferson, after President Harker?
How can you push back against them saying, we're going to skip?
Tough,
we think it makes sense. I mean, so he's joining the crowd and kind of...
Well, I like what Sarah Howe said with Wells Fargo. She said, look at the 3-month moving average. How do they pause skip if the 3-month moving average, which to me is good math, lifts up? I don't know where that statistic is, but, you know, the data's the data. I'm sorry.
The cumulative tightening of the last 12 months plus. We want to look around a little bit more and see the damage done. It's been a week of contradictions. We've talked about that a few times. If you look at the labour market data in America, it looks stellar, looks decent, looks great. look at manufacturing. Manufacturing worldwide, Lisa, it's screaming recession right now. We're not talking about the prospect of China stimulus because things are good. It's because manufacturing in Europe, in China, in the United States is flat out bad.
Is there any corollary to this rolling recession in specific sectors? How do you sort of make sense of the recession that you're seeing in manufacturing if it isn't bleeding into the services sector? There's going to be a real question about how much weakness there really is in other areas, whether it's filtering in or whether it will rebound before that happens.
End of 2015, we had this conversation around a manufacturing recession in China. Tom, do you remember?
Yeah.
We escaped things in the United States and we continued the expansion.
I think this, you know where I am on, John. You're busting my chops here. The aggregation of economic data, the aggregation of market data is hazardous to your pocketbook. Can I note a VIX 15.42, SPX rounded up 4,300 at 42.50? To me, John, it's just about equity markets adjusting to how well America's doing versus everyone else.
And equities are up right now by 0.5%. Let's go through the price action. Futures positive, yields a little bit higher by a single basis point. The euro trying to find some strength and struggling, just about positive on that currency pair. The euro against the dollar, 107.68. And crude up, as you might expect, Lisa, up 1.5%, 71.14.
For now, and we're going to talk to our next guest who probably would fade the China stimulus argument, which I think will be interesting to discuss. At 8:30 a.m., we do get the May payrolls report. There have been 13 straight months of upside surprises. What happens if that gets broken? What happens if it doesn't? How does this get parsed out at a time when the unemployment rate is still historically low and the Fed would like to see a little bit of loosening in that market? Today, JP Morgan COO Dan Pinto and Citi CEO Jane Fraser are among speakers at the Bernstein conference. Very curious to see whether they have that changed tone that we heard from Goldman Sachs' John Waldron yesterday about a greater degree of caution and possible declines in trading volumes and trading revenues. And this weekend, the OPEC Plus meeting in Vienna on Saturday and Sunday. Production cuts, agreement among the constituents. What message are they trying to get across at a time when oil isn't that low historically? And somehow this is catastrophic for Saudi Arabia. They want to get the prices up and they want to jawbone it up, and they're going to disinvite certain journalists as a response.
So to be clear, this is an OPEC Plus meeting. Like Russia will be there?
The plus indicates
the
so,
plus, yeah. Okay.
Yeah.
That's different than the cartel, isn't it?
Well, it's been that way for a while now, hasn't it?
Yeah, for their 8-minute meetings. Are we assuming a longer minute meeting now? That's where Powell got the idea for the Jackson Hole speech.
Is that right? From OPEC
First,
Plus.
create no harm.
We're going to hike 100 basis points and then move on. With Thin, Global Head of Currency Strategy at Brown Brothers Harriman, joins us now. We're wonderful to catch up with you, sir. Payroll's about 85 minutes away or so. When have you got an idea of how big that number needs to be to reintroduce the prospect of a rate hike this month?
First of all, thanks. It's always a pleasure to appear with you guys. So thanks for having me. Look, to Lisa's point, it's strange to me that the Fed is talking about a skip, at least some of the officials, because in the past, they've been saying it's data dependent. Well, if it's data dependent, how can you pre-commit to a skip? So I find it very puzzling. I think they may, end up regretting painting themselves into such a corner, because if you look at the JOLTS data, you look at the ADP data, it looks like we're going to get an upside surprise. Consensus is 195K. Probably something 250, north of 250K would really get the Fed's attention. Obviously, as you point out, there's also CPI and PPI data out later in the month. Again, it should be data dependent. And to see the Fed sort of pre-commit to a skip, it's very puzzling. It's another one of those communication problems that I think the Fed has been plagued with from time to time.
But what does data dependent mean right now, when you can make an argument, any argument you want from the data that we have?
Yes, absolutely. But I think really what they are looking at is the jobs data and the CPI data, and to a lesser extent, obviously PCE as well. Those are really the big three. The PPI is not so important because there's a whole question of whether firms can pass through to the consumer, et cetera, et cetera. But really, it's unfortunate that the Fed, look, for every central bank is struggling with the same issue, right? Elevated inflation, teen transitory loss big time, and they're really trying to catch up. I think a lot of the policymakers on the Fed are starting to get nervous because they've come so far so fast. But to me, it's like if you're going to do it, just get it over with.
Right.
Why skip a month? Just get it over with. Let's see where the end ends up. I'm sorry. Go ahead.
No, Dr. Thin, from your time at Columbia, and with your heritage of Burma and north across the Pacific Rim to Japan, you've owned the high ground on analysis of China. What a bombshell this morning as Bloomberg reports. Guess what? They're going to do stimulus. This time around, what is the desperation in Beijing to provide a stimulus to China? And quite frankly, after your South Korea report, the rest of the Pacific Rim?
Yeah, so Tom, really China's been a puzzle, right? We had the big champagne celebration back in December when the reopening was announced. Everyone was, ready to have a big boost to global growth, but that simply hasn't materialized. And that's part of the reason is that China's turned much more inward, right? And that's for a variety of reasons. But we know that under President Xi, in his third term, it's going to be much more domestically focused. So we haven't seen any impact really on the regional exports, Korean exports, Taiwan export orders, Japan, Germany, all really still weak. So there's no global growth bullet from China. To me, what's worrisome is that they're falling back on basically pumping air back into a property bubble that was already deflating. It's a default setting that they have. I think it's each time it's marginally less effective and becomes marginally more dangerous.
Right.
It's a muddle through approach, but I think look, we know all the stories about the ghost cities and unused apartment buildings and et cetera, and this isn't going to help. So I remain pretty negative on China. I think I think markets got really got overly bullish on the China story.
Will they export disinflation to the United States?
Well, that's obviously the risk. I think the CPI, PPI out next week. The PPI is already in deflationary territory for the mainland, and CPI is something like 0.3, 0.2%. So in a world of high inflation, that's actually not a bad thing. So, unintentionally or not, China may end up helping the global economy through that channel rather than really through the growth channel. But either way, the days of China growing, even 5, 6, 7% are really over. I think they'll be lucky if they have a four handle. And it's part of the maturing of an emerging market economy. But the inward-looking focus of China is certainly, I think, a real game changer for emerging markets as a whole, for commodities, really for the global economy. And we're just seeing the beginning of that.
You're raising such an important question, Win. It really questions whether equities should be up outside of China off the back of reporting like this morning. Is that what you're suggesting?
Yeah, absolutely. And look, we look at coal prices, iron ore prices, oil prices, and the fact that OPEC is talking about, probably, contemplating another output cut, despite the China reopening, just tells us that really the global impact has been really limited. It just hasn't really shown up in any of the sort of tea leaves that one looks at. So, look, global growth is slowing this year. We're not going to see really monetary policies being tightened around the world. But to me, the global recovery story is really a 2024 story if we're lucky. And, we haven't even seen the U.S. recession yet.
Yeah,
that's coming. That's coming. I have no doubt about it. The timing is obviously the question. But the good news is it's a Fed-induced, policy-induced recession. It's not a global financial crisis. It's not a pandemic.
Right.
We're back to normal, right? It's sort of a normal business cycle. But right now, we're in the sort of the bad part of the cycle.
Win Thin of Brown Brothers Harriman. Win, thank you, sir. I think Mike McKee said it yesterday. Every year for the last however many years, we've been talking about a recession in the next 3 months, right? We've been doing that all year. Did it all last year. 3 months away.
Yeah,
18
months.
3 months away.
Yeah, 18 months.
3 months away. Yeah. Is it 3 months away?
Who knows? How does anyone have an edge on saying that it is going to be or isn't going to be? And this is really the trick.
Well,
so how do you really interpret data that's come in surprising, that hasn't really confirmed recession? Maybe it's slowing down. What are we talking about even with hard landing and soft landing, which people have been debating for 12 months?
I've been
no landing.
Yeah.
What's that?
To me, it's the politicians do this better. It's not about a recession. It's half of America's flat on their back, and a quarter of America's prospering, et cetera. But I have trouble with the certitude of an NBER recession definition. Where, John, you can get half of 1%, 1% real GDP growth. That's going to feel like a recession to a lot of people.
If you're hanging out, no one in this market is waiting for a group of economists to get together and look back at the last year and say, that was it, Lisa, that was it. If you want a quote that captures exactly what you just said about half of America being flat on its back, the Dollar General CEO, our customers are saying they're having to rely more on food banks, savings, credit cards. Torsten Slock of Apollo yesterday, Lisa, I know you looked at the same chart because we read the same stuff. Delinquency rates, credit cards, not moving in the right direction.
I don't read anything.
We saw something similar from Macy's. This is a serious issue for a lot of people. And so at what point does this become broader?
You stopped reading a long time ago. I'll tell you all a story one day about a guest. Tom and I anchoring out of London and a guest coming on set. In fact, I'll share it now. I've got 20 seconds. Comes on set. It's got a new book, right? Book's just come out. TK quickly flicks through it, picks a chapter, a page. I was reading this last night, never read it before. The guest, should have seen the guest's face, just lights up, thinking TK's read his book. He never read it. Nadia Lovely, UBS, coming up in the next hour.
I read Nadia's research. We're going to do it on the break. We're going to do it on the break, John, please. Yes, Amy, I'll read Nadia's research, please.
Gotta love that. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. China's Ambassador Li Wei says it would be difficult for Russia and Ukraine to currently hold meaningful talks to end their conflict as Beijing tries to broker a peace deal. Li has been tasked with promoting Beijing's efforts to negotiate an end to Russia's war in Ukraine, part of a wider blueprint spearheaded by President Xi Jinping, Russia's biggest diplomatic backer. In Singapore, Pentagon Chief Lloyd Austin and his Chinese counterpart Li Shangfu are among more than 600 military leaders, policymakers, and analysts from 40 nations taking part in the annual Shangri-La Dialogue. Now, the U.S. says Beijing has ruled out a meeting between the two military chiefs. With China frustrated, the Biden administration hasn't removed sanctions the U.S. placed on Li in 2018. The CEO of Palantir says new AI developments are so powerful that he isn't sure they should even be offered to some customers. Speaking exclusively to Bloomberg, Alex Karp says he's wary about providing the tools to local law enforcement agencies for purposes such as surveillance.
Usually we have to go out and find people. Now we have customers, especially in the U.S., just calling us every day.
You said the demand is huge. Yeah. Can you quantify it in some way?
Well, you know, usually, we've had a number of inbound calls.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. So far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jay Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May Jobs Report, today on Bloomberg Television and Radio.
This demanded a bipartisan solution. We knew we'd need to come together for a solution like the one that passed tonight. And so I'm happy to stand here passing this critical legislation to support our families, preserve vital programs, and most importantly, avoid catastrophic default.
And pass it did, 63 to 36. Senate Majority Leader Chuck Schumer there weighing in on the passing of that bill. The President of the United States weighing in as well. No one gets everything they want in a negotiation, but make no mistake about it, this bipartisan agreement is a big win for our economy and the American people. The president addressing the American people, addressing the nation a little bit later on this evening, and then we can leave this drama behind, Tom.
Oh, that's a really
hopefully
good
move
insight. Are we leaving this drama behind? I mean, we're going to talk to Anne-Marie here in a second. I guess she'll drive it forward. But the answer is there's follow-on agreements, as we talked about yesterday, where they have controlled spending or it all falls apart down the road. I wonder how far down the road is.
Speaker McCarthy, big win. Got to reflect on that.
Yes.
Big win. Considering where he was, 15 votes it took to become Speaker. 15. And we were doubting how long he could hold on. Managed to pass a bill through the House. Managed to do it again, Lisa. Managed to come to an agreement with the president, who said he was not going to negotiate over the debt ceiling, and then did. Is he in better standing with the country? Possibly. With his party? Remains to be seen.
They're still talking about possibly putting in a vote to remove him. I have to wonder whether they almost have to basically show, oh, we're not happy with some agreement because it kind of violated things, but they're not going to actually oust him. And if they forgot, if for some reason they did, Democrats would come to his rescue.
What's amazing about the sitting president as well is that he talked about uniting the country, and he's managed to do some things on a bipartisan basis. But then at the same time, simultaneously, has managed to ostracize big chunks of the country as well. And hasn't done anything to unite the country, Tom. It's kind of amazing. If you look at substance and certain bills that he's managed to pass with the help of people on the other side of the aisle, there's plenty to talk about there on the campaign trail. But for a lot of people, if you ask them about the optics, who this president represents, I think a lot of Republicans, Tom, would say,
totally agree.
Not us. Not us.
Well, it's the modern convention. I mean, Roger Ailes invented this at Fox, and it's something people clearly like to talk about on both sides of the aisle, and it's led to a visible, almost entertainment polarity here. Is the same equivalency in the United Kingdom? I don't think so. My distant view is it's just not as frenzied on the far left, far right in other countries.
Becoming more that
here.
way. I think it's becoming more that way more recently over the last few years.
Let's get to it. And this is, of course, on a Friday that has changed. Anne-Marie Horton is our Bloomberg change agent in Washington, putting together Balance of Power with Joe Matthew this evening as well. Is it over, Anne-Marie, or is there debris after this that you have to study, that you have to report on?
Well, the debt limit crisis is over in the sense that we will not have this default. The president will be speaking this evening. I think it's notable he's speaking tonight because he has, for the most part, really tried to remain silent in terms of the fact that if you look at him versus Speaker McCarthy, who was giving a gaggle, which felt like every 15 or 20 minutes with reporters, this is the president's moment to say and why he thinks actually his negotiating team can claim victory. The debris that you need to watch now, of course, is how Speaker McCarthy really just navigates the rest of the year and the infighting within his own party. He got 2/3 of Republicans to vote for this, but still, when you look at the numbers, more Democrats voted for this bill in the House than Republicans. And at the same time, you do have members on the far right, some of them wanting to have a vote, potentially call for his removal, a vote of no confidence, a motion of no confidence for him. At this moment, I think it's overblown, but potentially if other issues arise that these individuals do not agree with him on, you could potentially see this being used as leverage against him.
MH, this is a president that surely just goes into campaign mode now. They're not going to do anything else, are they?
Well, of course, this deal means they also have to make sure they're setting appropriations. So there's going to be another big fight as we head towards October 1st. And I think what was really interesting yesterday was Senator Schumer's comments in the Senate, really trying to assuage senators' concerns about the fact that there could be these carve-outs, these supplementals, call it what you need it be, for emergency need of funds, whether that's fentanyl crisis domestically, whether or not that's defense for Ukraine, because many of the Republican defense hawks did not think this deal went far enough when it came to the defense budget. So there's going to be other issues, but you're right, Jonathan. We are a little bit more than 500 days out from the next election cycle. And it's a divided government, so President Biden will be looking to see how he shores up those votes as we go into 2024.
When you talk about the divisions in the Republican Party, I am curious about some of the divisions that were really made evident in the Democratic Party. The Joe Manchin versus Tim Kaine battle was fascinating, where basically Tim Kaine introduced an amendment to strip out the pipeline provisions and permitting process for Joe Manchin. What do you make of this, not with respect to just the debt ceiling debate, but also going forward, how this really represents the polarities of the Democratic Party?
Well, I think this was on full display during the president's first year when he was trying to get through Build Back Better. It really was Joe Manchin versus the White House. When it comes to this specific pipeline, what Senator Kaine took issue with is that this was included in the debt ceiling bill, which he didn't understand why, and it affects his state of Virginia. So he wanted this amendment to strip it out, and he had a lot of harsh criticism for the White House regarding this. But the White House will tell you this bill, this pipeline was always going to happen. So we were allowed to have it come in. I think whether or not you look on the left or the right, there's obvious divisions within the party. I think what this bill does show is a president that had to move to the center to get something done. And he had to sit down with Speaker McCarthy to make sure that there was no default and give in on some issues.
Emery, quickly here, the president's going to step up to a podium tonight at 7 p.m., and you know he's going to make a joke about looking for sandbags on the floor. John mentioned this earlier. We're so sensitive to both Mr. Biden and Mr. Trump falling down, whatever, the whole age thing as well. Does this thing go away by Saturday morning, 10 a.m. when I'm watching Manchester United and Manchester City, or does this thing have legs? Worry about falling down.
I think potentially you can see this go into the Sunday shows. I think it's less about the president falling. I think it's more about the concerns of what that means. Early on this month, the ABC Washington Post poll had about 70% of Americans thought that the president was just too old to have another term. So when you see him falling, it is those types of headlines that obviously are concerning for the Democratic Party. He's falling. He's a much older president, and yet he wants another 4 years.
AMH, thank you. The latest down in Washington, D.C. and beyond. This should be in a pub quiz. Who was Hillary Clinton's running mate in 2016? That should be in a pub quiz. Tim Kaine.
Oh, that's right.
Can you think of anyone more vanilla?
I honestly couldn't remember. I am embarrassed to say.
It's a nice guy. He's fun.
Just that's it. A nice guy. A nice guy.
10 a.m. tomorrow morning.
Manchester City. Yeah.
John, I mean, am I right to say it's like a nationwide baseball tournament and then the Yankees play the Mets? I mean, is that the equivalent? The FA thing is a United Kingdom
It's
thing?
a very old cup competition, but it goes all the way down to the lower leagues. So anyone can ultimately end up in the final. So you end up with situations sometimes where you have really big clubs, Manchester City playing really small teams in really small stadiums, and those small clubs get TV money. It's very cool still.
Will the nation be riveted by the red and blue of Manchester playing? Like, do they play their best players?
They'll play their best players. It's important. So Manchester City's going through the treble, the league title, the
Premier
FA
League,
Cup, the Champions League.
Very cool.
So Manchester United get the opportunity to stop them and disrupt them from winning everything this year.
But my childhood as Man U is like the Yankees.
That's the heritage,
of the United Kingdom.
And now Man City's got the money.
Man City's got the money, and they've really taken over the generational thing.
In a big way.
Yeah.
They're the winners right now. They're dominating.
They're
They've got the money. They've got the players.
When I watch them as a complete amateur, there's absolutely no weak players on the field.
That's because they've spent a huge amount of money. Massive. Bramo follows this now too.
Oh, yeah.
There's like an asterisk next to everything Manchester City do because opposing fans are like, yes, but they bought it.
Exactly, and it's not as good, right?
And they cheated.
Are you going to watch this tomorrow at 10 a.m.? Is this like a big enough deal to...
Spanish Grand Prix tomorrow, qualifying.
The qualies are tomorrow?
Qualies tomorrow morning.
They took the chicane out.
in big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Payrolls report 60 minutes away. Jobs just around the corner. We're told it's National Donut Day, but we're more serious here. We talk about things you care about, like the economic data in the Federal Reserve, so let's do that now. Equity futures on the S&P 500.
Please bring them over here right now.
Chocolate cruller.
Positive, up 0.6%. Just pretending to be business TV, you know. Over on the NASDAQ, up by 0.6% as well. Equities up. Yields look like this in a bond market. 2-year, 10-year, 30-year. 2-year yield actually down on the week. Governor Jefferson just poured ice-cold water over any meaning to the economic data whatsoever. I'm looking forward to the conversation we'll have with Morgan Stanley in a moment on that. But, Lisa, that seems to be the takeaway from a lot of people. That speech, that address, call it what you will, just really de-emphasized the incoming information going into the quiet period.
I totally agree, especially if we get data today that is an upside surprise. How can they turn around and say, actually, now we can't wait? How do they then say, well, actually, now it doesn't make sense to skip? We actually have enough to think that there is some sort of runaway inflation or runaway power in the economy that we didn't know a day earlier. It makes it very difficult for them on a messaging level.
Data dependent, except we're not dependent on this data. We're dependent on all the other data and all the other information that comes in between now and July, which is why we went on this rant. I went on this rant around the last Federal Reserve decision. Data dependence is absolutely meaningless. You can attach whatever meaning you want to it whenever you want and change it whenever you fancy, which is what these Federal Reserve officials do. When they don't want to answer the question, I always sit in front of them. They're very polite individuals. You do too. We all do. When they don't want to answer the question, they say, we are data dependent. We will be data dependent. But, you know, what does that actually mean?
It means they don't know what to do right now.
Sure.
And I think that's really the bottom line. They don't know what to do. And as investors, you can't really rely on the Fed to give answers in the same kind of way that they did during the era of financial repression. That's upending a lot of the traditional trading strategies that grew up in the past 15 years.
So we skip. Let's skip to this. In foreign exchange, there is talk of stimulus, a package, potentially. Our reporting suggesting that a package of stimulus measures, supportive measures of the property market in China is being considered. That means you've got a stronger Chinese currency this morning. Lifting commodities as well, but I have to say this is really marginal stuff. If you look at copper, gone are the days where you'd hear China's stimulus and copper was up like 2, 3, 4, 5%. Copper this morning, Tom, up by 1%. Not a big move. Crude up by 1%. Not a big move.
We don't have time here because we've got an important guest, but just as simple as that, the correlations on my screen scream melt up. I don't know if we're going to get that. That's what it looks like.
Crude 71.30 this morning.
Well, there certainly is a melt up in certain shares, particularly Lululemon. We talked about it yesterday. It did come out after the bell.
You nailed it. The first thing I looked at today.
All I can say is it's really interesting to see the shares up more than 15%. They reported net revenue in the first quarter that beat estimates. They talked about strength talk about the K-shaped recovery and the difference between the Macy's and the Dollar Generals of the world, and then Lululemon, where you buy a pair of stretch pants for more than $100, and that those things are flying off the shelves, particularly in China. It gives a sense of who has discretionary spending and who doesn't. Broadcom, shares are lower by 0.7% after reporting earnings. They even tried to bolster their valuation by saying AI, but AI, and it didn't work. It did for a hot second, but then they went down because they just have a broader issue on their hands of waning demand for certain legacy chips. And Dell shares are lower by more than 3%, despite beating analyst estimates. Again, they're the winners and the losers of this moment. If you mention AI and have the chops to back it up, you win. If you don't, and you're kind of depending on a PC business that is sort of tepid right now, it's going to be a hard sell.
I'm pleased you brought up Lulu. You mentioned it yesterday as an important thing for us to look for.
Yeah.
Lulu was okay. Nordstrom is hanging on. Then you look at the lower end of stuff. Dollar General, just brutal. I mean, really, really brutal. The commentary on their consumer, their customer, did not paint a pretty picture of this US economy at all, which is going to fly in the face of what we hear this week about the labour market. I've got no idea what this number looks like in an hour, but you look back at claims, vacancies, the ADP report, all those top-line numbers say things are okay in the labour market. Then you hear that commentary from Dollar General, Tom. It just sounds terrible out there for their customers.
And the bifurcation at Macy's between Bloomingdale's, not bad at all. Dana Telsey reporting that. And then Macy's challenge. She lowered her price target for Macy's yesterday.
Looking ahead, Tom, to payrolls about an hour from now or so. We're looking for 195,000 jobs. Unemployment to come higher to about 3.5% or so from 3.4%. Sarah Wolf and a team at Morgan Stanley coming in at the low end, looking for about 170,000 jobs. And unemployment, Tom, to stick at 3.4%.
In the heritage of Morgan Stanley Economics and all the work of Ellen Zentner on consumption, following along with great strength is their senior economist, Sarah Wolf, joining us this morning. You are consumer focused. Is the consumer on the edge of recession?
I don't think the consumer's on the edge of recession. I think that we're definitely seeing weak spots. The lower end consumer maybe has been recessionary for the past year. Middle, higher income consumers still doing okay. We're seeing some notes of trade down, that discretionary is starting to pull back. But we're in a weaker economy today than we were last year. There's less pent up demand. There's less savings. Why would discretionary spending still be so strong?
John mentions your below 200,000 statistic that we're going to see at 8:30 today. What number do you need to see equating into a 3-month moving average for non-farm payrolls, which changes the Fed from pause, skip silliness to lifting rates?
Listen, the bar is much higher now post-Jefferson. You guys said it. I think that there was a lot more focus earlier on the week on payrolls, and now Jefferson squashed a lot of that.
Give me a number.
All right, I'll give you a number. I think if we saw 2 months of an acceleration in payroll, so if we're getting 250 or above today with no downward revisions to last month, that's 2-month acceleration. I think that puts some concern, of course, that jobs are re-accelerating, but still bar very high.
What's more important, the jobs number or payrolls growth?
It's going to matter where we are on the 3-month moving average. I think that's what the Fed's watching very closely. With our forecast, 3-month moving average is coming down from about 220,000 to 196. So smoothing that out, there's still some room for an upside surprise on our 170K number and still have the 3-month moving average coming down. I want to make one more really important point.
Sure.
5 out of the last 6 years, April gets revised down with the May payroll report. So I think that's...
Why is that?
So part of it is the seasonal hurdle. There's a higher seasonal hurdle. So typically that causes some downward revision, but it's also the fact that the seasonal hurdle this past last month was about 640,000. Typically it's 800,000. So if we were to see some adjustment to historical seasonals, that would mean a lower print on April. So I think that's going to be really important to watch. Similar to last month, where we got 250 on headline, but massive downward revisions to the 2 months prior, and so market pricing didn't move too much off the report.
I'm always interested, Sarah, in how the conversation changes just compared to where we are now, compared to where we were maybe a couple of months ago. A couple of months ago, we were talking about communicating a pause and trying to figure out how high the bar was for cuts. And now we're here talking about a skip and discussing how high the bar is for more hikes. What's changed in the last month or so?
I think we've got some weaker data that's come in. I mean, you saw the beige book that came out yesterday. I thought that was a pretty soft beige book. They basically said...
I thought the same thing, too.
Yeah. economic activity.
He doesn't read the beige book.
You don't read the beige
He's
book?
never read the beige book.
In honor of the late Richie Amarone at Bloomberg, I do not read the beige book.
Well, I read it top to bottom.
Thank you.
And it was interesting.
That's why you're here, Sarah.
Thank you for having me. It was softer. Basically said economic activities little changed. That's in line with our GDP tracking, which is basically 0% growth for the second quarter. There was notes that there's consumer trade down. There's less ability for businesses to push through pricing power, that there's a pullback in discretionary. So there's definitely elements of weakness that we're seeing coming through the data, and I think that's been reflected in some of the Fed speak as well.
Have we killed off the fears of runaway inflation? Is that basically the tail risk that's almost been taken off the table over the past couple of months?
I don't think it's been fully taken off the table, but I think that people are finally realizing that just the way that inflation was surprising to the upside constantly on the way up, we could also see it come down the same way. And I think that the labor market data, but also what we're seeing on new orders for ISM manufacturing coming down, prices paid in ISM manufacturing coming down, all these are good indicators that goods deflation is going to continue well underway.
We were talking with Bob Michael of JP Morgan Asset Management, and he was saying he expects a real rapid disinflation later in this year, outright deflation in certain segments, particularly in the goods sectors. Do you agree? Do you think that what we've seen over the past few months, particularly with wages as well, which have slowed down, do you also expect a much faster rate of disinflation than you previously thought earlier in the year?
Definitely. I mean, we have the labor market slowing pretty substantially in the coming months. We're getting down to about 40,000 jobs at the low, and we already hit that in August. So we're only a couple months away from that, and that's going to help bring wages down with it, less churn, and that's that lead through into core services disinflation. So that definitely accelerates back half of the year, and all the leading indicators are pointing to more broad-based deflation in core goods, even outside of used vehicle prices.
Just to be clear, do you think that we can get to 4.5% unemployment by year end?
No, we are much below consensus.
Where are you?
We're about 4.1% by the end of the year, and I think the Fed's going to have to mark their summary of economic projections in June lower. 4.5% is going to be really hard to achieve. We're at 3.4%, and we're halfway through the year. You'd have to see some big negative job prints, not big, but moderate negative job prints to get to 4.5%.
This is what's going to be interesting about the June meeting. How are they going to reconcile not hiking with a shift in their projections that may well suggest that they should be hiking?
Inflation's coming in along with expectations, so I don't think they need to touch inflation. I don't think they need to touch their economic projections on GDP. I think what the lower unemployment rate says is that they're actually able to reach their target without hurting the labor market more, which was in line with Powell's original commentary that we could get job openings to come down, hiring to come down without layoffs to rise. Maybe it's even better than what they expected and more in line with actually our forecasts.
What I feel like they're communicating right now is we can skip June and consider July. Will that be implied in the dot plot, given that the previous round was a dot that is essentially where we are right now?
No, I don't think that they're going to move the dot plot. Of course, it's data dependent, so anything could happen in the next couple of months, kind of data dependent. But at this point, with inflation coming in line with their expectations, there's no reason for them to change the dot plot. Why would they do that?
Sarah Wolf of Morgan Stanley. Sarah, thank you.
Thanks for
having me.
There will
be some people later satisfied with where the rates are at and others who still want to go higher.
Well, and it raises this question, if unemployment isn't taking the hit they expected, but inflation is coming down, can they celebrate victory, or are they not quashing things enough, and are they leaving things too sticky? But yeah, that's exactly to your point. Do people go further and want to see more destruction in a labor market when that's against their mandate, their other part of their mandate?
I'm really looking forward to his speech in August, you know.
I agree.
Jackson Hole. We'll be there in Wyoming, and we can sort of bookend the two speeches and compare and contrast what he said 12 months before. Pain. Where's unemployment going to be when he sits there in August?
Agree.
3 handle still?
3.5%.
What's a 3 handle still? Can you imagine?
To Sarah's comments, late August will be really, really interesting.
Randy Krosner, former Fed governor, joining us, I believe, around the table in about 30 minutes' time. So that'll be cool. We'll catch up with him just ahead of payrolls, about 48 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China's Ambassador Li Wei says it would be difficult for Russia and Ukraine to currently hold meaningful talks to end their conflict as Beijing tries to broker a peace deal. Li has been tasked with promoting Beijing's efforts to negotiate an end to Russia's war in Ukraine, part of a wider blueprint spearheaded by President Xi Jinping, Russia's biggest diplomatic backer. Bloomberg has learned Turkish President Recep Tayyip Erdogan will tap Mehmet Simsek as his new Treasury and Finance Minister. Simsek is an advocate of conventional economics. Supporters say his appointment will likely shore market confidence. Simsek is said to be in charge of all of Turkey's economic policies in the new cabinet. Erdogan won re-election on Sunday, extending his more than 2 decades in power. Netflix shareholders voted to reject pay packages for the company's leadership, including co-chief executive officers Ted Sarandos and Greg Peters. Now, Sarandos is supposed to make as much as $40 million between his salary, bonus, and stock options, while Peters is supposed to make $34.6 million. Netflix's board can disregard the results, though the vote is significant given the current tension between the major Hollywood studios and screenwriters. And the Pentagon is set to buy Starlink satellite communications terminals from services from Elon Musk's SpaceX for use by the Ukrainian military. The U.S. has praised the role that the terminals have played in Kyiv's war effort, seeing them as vital for the country's defense. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
They're going to take a pause because they believe that there are long and variable legs of monetary policy, and so they want to see the effects of prior actions. But they've characterized it as a skip because they think that they'll probably have to do a little bit more, and we'll probably see that in the summary of economic projections. We'll probably see a couple, one or two additional rate hikes penciled in for 2023.
Bill Dudley there, the former New York Fed president, a Bloomberg opinion columnist, just distracted by a tweet. Thank you for writing in, everyone, as always. I think you need to have a Bloomberg TV summer educational road trip to London HQ for a few months so Tom can immerse himself in all things British. Do Ascot, Henley, Wimbledon, get him a top hat, take him into the city of London to discover, do you Brits still call corn wheat?
No, but this is important.
Or wheat corn.
National Donut Day, the Death Stars. Andrew Ross Sorkin's eaten like 5 donuts this morning. It's embarrassing. And John, you taught me this.
What's that?
Greg's Sausage.
I'm
at Jubilee Station, I think it's called, down below. And we should, when in London, we should have Greg's Sausage Roll Day.
You want to go over there just to have sausage roll day?
Just to have sausage roll day. Lisa, they're phenomenal. They're like they got to be more nutritious than a damn donut, right?
I'm not sure about that. Not sure about that at all. If you are just tuning in, it's a serious conversation about payrolls.
Yes,
That's what we're doing this morning.
Within an hour.
We're about 43 minutes away from the payrolls report. This is a state of things going into it. Equities with a lift on the S&P 500, encouraged by some reporting here at Bloomberg that maybe you get a package of support from China for the property market over there. Property developers overnight in China rallying, the Chinese currency rallying, bit of a rally in commodities as well, crude up by 1.6%. Not a big one, though, up to $71.21. If you'd like to know where the bond market is, I can tell you where the 10-year is right now. The 10-year at the moment is around about 360 at 359.70.
3-month 10-year spread is one thing that sticks out today, negative 100 basis points, and that's where that Treasury yield, 3-month T-bill, still elevated versus that 10-year yield. Other than that, it's pretty quiescent, but John, I go back to a VIX of 15.45. Nobody's talking about it.
I'm looking at the 2-year down 20 basis points this week. What's interesting about that move, it's not about the data at all. Data's been pretty good, with the exception of the ISM manufacturing. You look at the labour market stuff we've had this week, claims, jolts, job openings, vacancies, small wrinkle, of course, the quits rate. You look at the ADP report, big move higher there as well. It's not about the data. It goes back to something Sarah Wolf from Morgan Stanley was talking about, something Lisa mentioned a few times, something we've had a discussion about. Governor Jefferson, presumed future Fed vice chair, just pouring cold water over any meaning in this payrolls report this morning for the June decision.
They need to wait. They need to see more data. 1 month is not going to really shake the tree that much. And so at some point, how much do we really see any kind of upside surprise that could really materially shift their thinking? That said, what we were just hearing from Sarah Wolf of Morgan Stanley, the revisions to the prior months, that will be much more interesting than I previously had imagined.
The revisions, I slam it into a 90-day moving average, 3-month moving average to smooth things out. This is a trap now at 7:49 coming up here on 40 Minutes of the Jobs Report. Because with Anna Wong, the chief U.S. economist for Bloomberg Economics, it's just simple. We can have 100% Fed chat because she's been so right about monetary policy in the United States. We digress this morning to the state of the American labor economy. Do you aggregate when you look at the labor economy, Dr. Wong, or do you look at parts of the labor economy, some really quite strong and others screaming recession?
Yeah, we look at the labor market from a firm size perspective, from different states' perspective. For example, we looked at whether which states are currently in recession right now, and we found that about 30% of the U.S. Population is currently living in states that fulfill the Psalms rule, which is a identification for concurrent occurrence of recession. We also looked at small firms versus large firms, and that's where things are interesting because large firms are the places that's laying off workers that are dominating news headlines. But small firms, they were not able to hire as many workers during the pandemic. Right. But even they, I think we have seen that even they are dropping their hiring plans and starting to lay off or freeze hiring.
Do we have a clear picture of the technology overlay on the American job economy, on our labor economy? I would guess it's going to take 10, 20, 30 years for people like Luigi Zingales to actually figure out what the technology overlay is.
Yeah, I mean, recently I've looked at some interesting data on reasons for laying off workers. And actually AI, some employers are already referencing AI as a reason for laying off workers. So I think the power of AI could lead to even accelerated layoffs for white-collar workers who actually during the pandemic benefited a lot from all these, work from remote from home working, and they're even more susceptible from being laid off because of AI going forward.
Do you think that it's probable that the unemployment rate rises to 4.5% by the end of this year? Do you think that it's going to rise more slowly, or do you think that there's going to be a seismic jump that perhaps isn't as linear as some of the recent progressions have shown?
Yeah, we looked exactly into this issue, and it's actually possible. So if a recession began in the summer, say July or August, we looked at the historical progression of non-farm payrolls, and it actually is entirely possible to see an unemployment rate going to 4.4 or 4.5%. That is conditional if a recession happens during the summer, starting in the summer.
Why is it that different states have such different backdrops? How does this sort of affect national policy if these specific regions are facing incredibly different economic realities?
Yeah, I think in the past recessions, usually all these bad things happen all at once. But in the current economy, we have a tech recession, we have a manufacturing recession, and if you look at the states, so obviously California would be affected by this, tech recession, but also, so I think that what we are experiencing right now is some sort of rolling recessions where you first have some states who are hit first. So the big question is whether the other states, which are, for example, states which have a more diverse industry base, equal in tech, finance, or manufacturing or non-manufacturing, those states are doing well. And the question is whether those states would fall into recession as well. And so far, they're looking quite good.
It's amazing looking at some of these unemployment numbers, Tom, across America.
Wichita.
2 handles in some places. It's nuts.
2, Columbus, Ohio, 3.4.
Wow.
And like you say, they're places of the 2 handle.
Anna Wong of Bloomberg Economics. Anna, thank you. The national average, I guess, at the moment, 3.5%. Looking for it to come in and around 3.5% later. But Lisa, to your point, that's been the post-pandemic story, hasn't it? In many places. There was all that criticism. Do you remember the criticism about the White House giving out too much money and people didn't want to come to work? Unemployment was very low. We need to get people back into the working population. And then those conversations died pretty quickly, didn't they?
And a lot of other conversations died with it. Right now, what you're getting is a growing sense of soft data pointing to a very much softening labor market. And I think that you can see that with the quits rate. You pointed to that in the JOLTS data, which I thought was really interesting. The people are quitting less. I also think that the back to work kind of trend, the back to office trend, is very much in direct correlation with the looser job market. If you're more concerned about keeping your job, you probably will be more inclined to go to the office, and your employer probably will feel more inclined to ask you to come back to said office. So I wonder how much we're hearing more about that because
you think the leverage is shifting away from the
without a doubt
employee and back to the employer?
Without a doubt, because you're seeing that right now. I mean, I think that what Meta said that 3 days a week yesterday, they'd like to see people back in the office. Amazon, they were protesting the return to office kinds of policies. And yet, how much protest can they actually do when they're laying off such significant parts of their workforce?
3 days a week's not so bad, is it? Monday, Friday, isn't that, 4-day weekend?
To us, I mean, that's kind of luxurious. But I mean, for different people who have set up their lives over the past few years.
Well, that's the issue, isn't it?
To be working from home, how do you readjust in short order without a pay rise, without some sort of structural changes to your life?
Especially the tech money that wanted to get out of San Francisco and how expensive it was and go somewhere else, Tom. Nice backyard, maybe a swimming pool, cash in that Meta check.
I got a family member that did
Build
this.
a family, not go to the office.
I got a family member that did this, but will they be paid less over the next 2, 3, 5 years? That's the question.
Well, we're on the same page about this, that if you really want to make this happen, have a 2-tier pay system.
Yeah.
I feel like people also are less engaged when they're working from home.
Oh, keep going.
I do. Well, look at that. We're running out of time. But I do think that...
Because we're engaged.
Keep going, Brahma.
We're fully engaged.
I'm just about to check the system and see if any managers are at home today. But yeah, carry on.
TV and radio from Tennis Channel, I'm Andrew Guy. A day after her 22nd birthday, world #1 Iga Swiatek eased into the 3rd round after blasting American Claire Liu off the court. After taking the opener 6-4, the defending champion played an almost perfect set, closing it out 6-love after just an hour and a half on court. The win was Swiatek's 30th of the season. Only Aryna Sabalenka has more victories so far this year on the WTA.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. We started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
There's this mountain of cash that consumers had on their balance sheets, and we see that starting to dwindle now.
The U.S. has been more resilient than anticipated.
The bigger shock of the last month is how soft the data outside the U.S. has been.
We look at the leading economic indicators, and they're still all pointing to recession.
I think it's going to be very hard to avoid a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Jobs Day on radio and television. We'll go beneath the headline data here in 29 minutes. Is Krosner in the building?
Randy's here, yeah.
The former Fed governor in the building.
I haven't spotted him yet, but I'm told he's going to be here in 15 minutes.
Yeah, maybe it'll be Goosley with him, and it'll be an interesting conversation. But it's an interesting Jobs Day coming up, and it's wrapped around a stock market that won't quit going higher, and all of this off of two items of news here, tangential to what we're going to see at 8:30, John, but maybe let's combine them in right now. China, we need stimulus, Bloomberg reports from our team in China. And two, Washington, Anne-Marie Horton says all clear on it.
Well, let's deal with China first.
Yeah.
China basically considering, according to our reporting, a package of measures to support the property market. 1. 2, payrolls later. I think the good thing about today is that if the data's good, it's just kind of good news because ultimately there's a belief that doesn't mean much for the Fed in June. That's the takeaway at the moment.
And the shift that you mentioned from Mr. Jefferson earlier.
Now, that might change at 8:30, granted, but based on what we know so far, that's the interpretation that ultimately you get an inline jobs report, and based on the communication from the Fed Governor Jefferson, who you mentioned,
right,
it doesn't look like that's going to change what he thinks they should do this month.
And maybe the theme is data dependency doesn't matter, so what we're all going to do at 8:30 when Mike McKee gives us the data is extend out. Lisa, you mentioned earlier the revisions. I'm going to the 3-month moving average. That's where we end up today.
how much is the risk to a downside surprise that could spur market action more than an upside surprise? If the Fed has basically capped the reaction function to an upside surprise, what happens if you get negativity and this idea that actually job creation is much weaker than people expected and the lag effects are here?
What does Sarah Wolf say of Morgan Stanley? 250 would get it done.
Yeah.
250.
That's a big number.
Without a big revision to the previous month.
Correct.
That's key too.
Correct.
Okay. And then you've got
That's a big
CPI on the
number.
13th. Well, 195. Tom, we've had so many upside surprises over the
True.
last year.
It's lifted up.
You can sit here and tell nice stories. I did one about 30 seconds, then they get blown up in 28 minutes' time.
Well, they do, and part of it's going to be wage growth as well. There's a presumption into this report of an ebbing wage growth. Nominal wage growth is maybe coming in a little bit, and of course the disinflation dynamic comes into that as well. So it's not just about non-farm payrolls, but it'll be. I'm fascinated by what we see today because I've been so wrong for 90 days.
You've not just been the only one, Tom. I think everybody has for months and months and months and months. Equity futures, as Tom indicated, positive this morning. Many reasons for it. There's a lift in the equity market on the S&P 500 on the week so far, heading towards a third week of gains on the Nasdaq 100 is on course for a sixth consecutive week of gains, the longest weekly streak going all the way back to 2021. Yields helping out this week, for once, down about 20 basis points at the front end on a 2-year, off the back of pretty decent data in America, with the exception of the ISM manufacturing read, largely because of the Fed speak so far this week, going into the quiet period, with the bulk of the committee seemingly coalescing around the idea that they can skip June, Tom, and maybe lean into July if they need to.
Oh, they go to July or they go on from there. But again, is it the lift in rates is a 50 basis point lift.
Busted. Absolutely busted.
Busted. There it is,
great.
Right there.
This
Come
is
on,
what he's
Nadia
doing.
Lovell appreciates
This is what,
that.
in fact, I might get in trouble for showing this because we don't have the rights to show it. So he's watching F1. That's what he's doing.
Red Bull's in the
I was
pit.
wondering why you look like you were listening to anything.
He's watching,
Come on, this is important stuff.
It's not he's watching practice. He's watching practice.
Are you that bored?
It's your fault. I mean,
you're watching practice. You're that into it now.
Daniel Ricciardo told me I have to watch practice to get a better understanding.
I was wondering why you're so distracted. I give up.
I'm not distracted. I'm ready to talk to Nadia Lovell here and just absolutely dive into the equity outcome of Jobs Day today.
What, whilst you're watching practice?
Thank God the makeup's not showing me blushing. Nadia Lovell saves us right now. Senior U.S. Equity Strategist at UBS Global. Nadia, it seems like the stock market is going opposite of all the angst in economics. Is that true?
It seems so. It's been a tough market to navigate, as we know that we've seen just wide dispersion in the market, and we have seen one of the narrowest breadth in the market, particularly for a market that's coming off of a bear market localized low. I mean, it's only a third of the S&P constituents that are outperforming the index since the October low. And if you look over the last month, that's even a smaller fraction. So, Tom, I would say this continuous narrowing of market leadership is not a hallmark of a new cycle. And we think that this makes the market a little bit more vulnerable. We know that it's the AI frenzy that's really the powerhouse of late. And we do believe in that trend, but we think that there's just a lot being discounted right now, and we just question the resiliency of this market going forward. It's now trending towards our upside scenario of 4,400 for this year, despite the fact that as you noted, the deteriorating macro backdrop. And so we just don't think that this cocktail is very appetizing at these levels.
Perhaps not on an overarching scale, but I do wonder whether there's opportunity created by just how narrow the breadth has been and the incredible losses in other areas. Bespoke Investment came out with this. The NASDAQ is outperforming the Dow, or did back in May, by 9.3 percentage points. That is the 9th widest margin of outperformance for the NASDAQ relative to the Dow in history. At what point do you start looking at some of the discarded companies as something of an opportunity?
We have been. I mean, we've sort of been looking at more the defensive areas of the market, like consumer staples as well as utilities, and coupling that with some cyclical exposure on industrials. We are concerned about the economy going forward, and we do think that the economy will slow down. Of course, there's a continuous debate on whether or not we end up in a recession. We think that we're probably going to not see any economic growth by the time we get to the end of the year. So it becomes a coin flip. And so we think from a positioning standpoint, you want to continue to defend, to lead in a bit into the defensive areas of the market and take the opportunities and take some chips off of some of those areas of the market that's really gone up and is feeling a little bit frothy at this point.
I've been hearing so many people say that they're going into defensives. Aren't they overpriced right now based on some of the others? What does it mean to even be defensive at a time when the economy is growing and there's sort of a rolling recession in different sectors?
There is a rolling recession in different sectors, but we haven't seen the full impact of tighter monetary policies. And we know that credit lending standards are tightening. And when you look at the forward indicator, which I think Jonathan has been pointing out for much of the morning, we pay very close attention to the ISM manufacturing index because that tends to have a very good correlation with earnings growth going forward. And that continues to deteriorate. We're even seeing the weakness in the new orders. We're seeing a normalization of that points to additional weaknesses ahead. And we know that credit lending standards have a very good correlation with job growth, particularly for small and mid-sized businesses. And while we're not seeing that deterioration immediately today, it does point to that there will be some ahead. So that's why we continue to believe that a defensive position is the right one in this environment of uncertainty as we get later in the year.
Trade for the brave. Buy the Hang Seng, sell AI. Nadia, are you willing to make it? That's what Michael Harnett brought up this morning over at BofA.
We do have a preference for China. The recovery there has been uneven, but we are seeing some encouraging data, particularly on the service side of the economy as when you look around the Labor Day weekend a few weeks ago. So we would lean in more on those areas, the leisure side of the Chinese economy and not so much your property side.
Nadia, are we modeling in disinflation, which is boosting the PE ratios or the presumed ratio of the market, and particularly the profit-making technology companies? Is this just the stock market getting out 6 months, or dare I say out a year, and expecting a disinflation?
Well, I think when you say about tech, I think people are looking 2-3 years out for AI revenues that might not materialize for everyone. Yes, we do favor the AI, big data, as well as cybersecurity. This is part of our ABC of Tech framework that we've been using for the last 2 years. But we do think that you have to become increasingly selective because there's a lot right now discounted, particularly in some of the semi names. So we think that it's less about the disinflation that we're seeing and more about the enthusiasm about the market opportunity for AI.
Nadia, thank you. Nadia Lovell there of UBS, going into payrolls about 20 minutes away. The good people of the Delta Sky Club not watching Formula One practice. Coleman writes in, the folks in the Delta Sky Club have good morning show taste, best in business. Thank you, Coleman. Appreciate that. You see, even the viewers, Tom, appreciating the programme more than maybe you are. What's the Allen Iverson rant from years and years ago? It's just practice, man. You ever seen that? That's a famous rant, Allen Iverson.
About
just
the practice here?
Just practice.
Well, this is an important question because every week they go to a different course and they have simulators, right? And it's serious stuff. They have to memorize the course.
Sure.
I mean, like big time.
And then we get to work out,
it's like life and death.
What are the best tyres to use around this track? How those tyres are holding up.
Are they doing that in
track.
practice?
That's what they're working out in practice right now. Different fuel loads.
They
all
do
of that
2
stuff.
practices.
Yeah.
And then they do quality.
You might get free practice 3,
Okay.
Yeah.
And they get a qualifier, which is where you sit in the start.
That's right. That's your position on the grid. Spain this weekend, right? After Monaco last weekend.
This is Barcelona, and it looks like the course is not as tight as Monaco. It's more
No, it's not a street race in the same way.
Yeah.
Fernando, can he get it done in his own country? That'd be cool.
33 is his big number. I don't know what that's about. It's like he's looking for his 33rd victory, and it's like
you know more about this than I do, honestly.
Well, I'm reading Autosport cover to cover every
I'm aware.
week.
You were texting me last night about it. I've got no idea what you were talking about.
The chicane. They took the chicane out. They're making Barcelona like it used to be, and less. They're trying to open it up, I think, and make it faster.
Okay. All right. Well, I look forward to your analysis next week after the race.
Yeah. This week, I'm going to do it right after the jobs report because I'm watching practice on Formula One TV.
It's just practice, man.
Yeah.
I can't believe you don't know that rant. Come on. Everyone at home knows that rant.
I remember it, John.
Yes, of course you do. Thank you. Former Fed Governor Randy Kroszner with us very, very shortly to talk about payrolls. The payrolls report 18 minutes away.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. China's Ambassador Li Hui says it would be difficult for Russia and Ukraine to currently hold meaningful talks to end their conflict as Beijing tries to broker a peace deal. Now, Li has been tasked with promoting Beijing's efforts to negotiate an end to Russia's war in Ukraine, part of a wider blueprint spearheaded by President Xi Jinping, Russia's biggest diplomatic backer. Bloomberg has learned Turkish President Recep Tayyip Erdogan will tap Mehmet Şimşek as his new Treasury and Finance Minister. Şimşek is an advocate of conventional economics. Supporters say his appointment will likely shore up market confidence. Şimşek is set to be in charge of Turkey's economic policies in the new cabinet. Erdogan won re-election on Sunday, extending his more than 2 decades in power. At least 9 people died in clashes between protesters and police after a Senegalese court sentenced the country's main opposition politician to jail, barring him from taking part in next year's presidential election. The government restricted the use of social media platforms, including Facebook, Twitter, and WhatsApp, in an effort to put an end to the unrest. And Novartis AG's Kisqali reduced the risk of tumors recurring by 25%. 9 out of 10 people who received the drug in addition to hormonal therapy after surgery were disease-free after 3 years, compared with 87% of those given just hormonal therapy. That's according to trial results that were presented today at the American Society of Clinical Oncology's annual meeting. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep Green World Cup. This is a 3.
As the economic picture does.
Is it be okay? Is getting ready to make a decision.
I do believe that we are close to the point where we can hold rates in place and let monetary policy do its work to bring inflation back to the target in a timely manner. Along this path, I project that we will see modest growth this year, with real GDP coming in a bit below 1%.
Just don't call it a pause, it's a skip. Fed President Patrick Harker doing a decent job of explaining that earlier this week. A decent job of explaining it, because this market was pricing in cuts. When it heard pause, it heard cuts. And Lisa, I guess they found an elegant way to tackle that issue this week.
It's working in markets. The market is buying it.
You said that, and that's important.
Right now, you are seeing an increased probability of a July rate hike, even though there is a much greater probability of a pause or a skip or whatever you want to call it at the meeting this month.
TK, data dependent on what data?
They're dependent on today's data, particularly with revisions in 3-month moving average, and then they're going to be dependent on the inflation report coming out, all the depth of that, and frankly, tangential stuff to inflation.
Payroll's 13 minutes away. June 13th CPI, June 14th Fed decision. Price action going into it all looks like this morning. Futures up by 0.4% on the S&P 500. Yields just a touch higher by, let's call it a basis point, Tom. Back to about 360 on a 10-year this morning.
If you're across the Hudson River in New Jersey up on the cliffs and you are good at mathematics, you possibly get to go to Brown University and excel, onto Harvard, and then establishing the definitive American financial economics career. Randy Krosner is the former governor of the Fed. He is a professor at the University of Chicago Booth School, and we're thrilled that you could join us on set today. Randy, I'm going to cut to the chase, and this goes back to a paper you wrote with Doug Irwin 1,000,000 years ago on things can change. There can be a theory, there can be a belief, and then things will change. In the time, it was a Republican Party and all of that. We've had a pandemic. We've had a series of jobs report. You've given us great perspective. How has the American labor economy changed given this pandemic?
Well, certainly we've talked a lot about the labor force participation rate being a lot lower than it had been before, especially for older workers. So I think that's a long-term change because of these the health issues and health concerns. We've also seen a slower return to work for younger workers. And when they're returning to work, they're not going into the office. And so that's also another long-term change.
One big conversation, Randy, and I'm sure you've been following it. How much of the information we learned today contributes to what we'll see on June 13th in CPI? How important is the contribution from this tight labor market to the price pressure in this economy?
It's certainly a very important piece because labor is such an important piece of the economy. Services is just such an important piece of what happens in the U.S., and that's primarily labor expense. And so if labor prices are going up, that is, wages are going up really rapidly, it's going to be very hard for prices to come down.
I keep asking this. What did we learn over the past 6 months? Because it seems like we're as much in a fog now as we were 6 months ago. So where are we in terms of our readjusted expectations for the labor market, for the stickiness of inflation, for the economic cycle?
Well, I think most people knew that it's easy for the inflation to go up fairly rapidly. It's much harder for it to come down. You know, it came down off of its peak, but now it's sort of bouncing around, depending on your favorite measure, 4 or 5%. And I think it's going to be much more difficult for it to come down from there. So I think we kind of knew that beforehand. The challenge is that I think no one expected the labor market to continue to be as strong as it is now. Even the most optimistic people didn't think that. So we're going to have those continuing pressures.
Do you think that that's okay to be able to do that, though? And that's honestly, Tom, what I keep wondering is, do we think that that's actually going to be okay for the Federal Reserve?
Well, that's what the hope is. You know, as I've mentioned on this program before, that's the immaculate disinflation, that somehow we can bring down the inflation rate without bringing the unemployment rate up. We've never done it before. I never say never about anything, but I don't put a high probability on it.
Oh, come on. You picked Goolsbee to be Chicago Fed president. You were out front on that.
All right.
We'll talk about that another time. Jobs Day today is so important. Luigi Zingales, the definitive foreign voice on American capitalism, said the thing that's separate from this country is we clear markets. On a Hayekian basis, we clear markets, we move on. Can we state American exceptionalism right now? That's been a theme around this desk today. Can we state American exceptionalism because we clear markets and a lot of people abroad don't?
Well, I hope we continue to have that because I think that's a very important part. It's a core part of what we are in the U.S. and core part of free markets. I'm actually going to the 300th birthday celebration of Adam Smith's birth just in a week or so with Doug Irwin in Edinburgh. Well, actually, it's going to be in Glasgow.
Okay, that's near Edinburgh.
Are we still clearing markets in America?
Relative is the key word.
Yes, exactly.
Relative to other countries.
I'm with you. That's very important. Because certainly it used to be this beacon of capitalism, and we've been taking shots at it a lot over the last couple of decades.
Can you come every day? This is great. Let's.
Sure.
You know, we can
set me up for the Bloomberg building here. It'd be great.
Payrolls. Randy, good news. We're on the same page about Fed comms this week.
Excellent.
I think they've done a decent job.
All right. I thought we were going to have to duke it out.
We don't have to fight. We don't have to fight. They've come up with an elegant way of really tackling this subject, which was the pause that we were all waiting for them to communicate, and they've come up with this word, skip. What does the word skip mean to you?
I think it means exactly what you guys have been talking about, that it's a temporary pause. So we skip this meeting, but that doesn't mean that you're staying where you are.
And you're not pre-committing to a move after that, whether it's a cut or a hike?
Well, no, I think it's really unlikely that they're going to be cutting anytime soon, as we've talked about before. I think they're going to hang tough. I know that most people in the markets haven't seen them hang tough because it's been 25 years since the Fed has really tried to take the punch bowl away. But I think that's what they're going to do, and they're really committed to that. That's one of the reasons why they keep invoking Volcker. I know most people haven't even heard of Volcker, but Volcker was a very important figure who really stood up to inflation, and that's why they keep invoking him, because it was really tough when he was there, and he was hanging really tough. Unfortunately, the unemployment rate went up really high, and they're hoping to avoid that extreme circumstance.
Have we gotten closer to the chance of a painless sort of disinflation that a lot of people talked about, or have we gotten further away?
Well, the labor market still is strong. The challenge is that, if you look at like core personal consumption expenditure index, that ticked up, and that's really much more predictive of where inflation is going than typically the headline numbers, as the Fed's going to be concerned about that. So that strength in the labor market is going to make it more difficult for inflation to come down.
What do you make of the housing market right now? A lot of people have been looking at it with growing concern, particularly not just in residential, but also in commercial real estate. Is that kind of a tipping point, non-linear kind of development that could really challenge this notion of a painless disinflation?
So I think you're spot on that. So right now, the residential housing market is okay. There's very little supply coming on out because no one wants to give up their 2% or 3% 30-year mortgage. But if the unemployment rate goes up, then they got to move, or they may not be able to pay that. And suddenly there'll be a lot of supply coming on and pushing prices down. Commercial real estate is in a real difficult position. I mean, people are not going back to the office. Capitalization rates are going to be doubling what they were before, and they don't have 30-year fixed-rate mortgages. They have much shorter horizon mortgages. So we've got $1.5 trillion of commercial real estate that's up for refinancing in the next couple of years.
We all wish we had a 30-year fix with a 2.5% interest rate.
Krosner's got one. Krosner's got
We could go back in time and line up outside First Republic. Just give me as much as possible, please.
Don't pay for 10 years. Right?
2.5%. Just awesome.
John, we could go to the University of Glasgow, the Adam Smith Business School.
That's cool.
Irwin and Krosner. They have the 300-year anniversary. You get a plaid. They have a special Scottish plaid in honor of Adam Smith.
Nice.
You wear a kilt to the dinner.
Do you? We could wear kilts on the show.
Yes.
Kilts to the dinner.
Yeah.
Oh, okay.
But seriously, all the heavyweights are going to be there. We could do the show from there, and
that'd be great.
I wanted to get to Mike McKee for a quick word ahead of payrolls, but given the clock and the importance of this conversation, maybe we don't have time. Mike, what are you looking for in about 5 minutes, buddy?
I'm looking for Randy in a kilt. And Tom in a kilt. I think you got to, if you're leaning which way, you probably have to lean towards a slightly stronger jobs report, because we've had 13 months in a row where the jobs report has beaten the consensus. On the other hand, April, as you heard earlier from Ms. Wolf, is a month with a seasonal adjustment problem that could bring it down. The whisper number on Wall Street, 225. So it seems like most people out there who are watching today, if they're not trying on their kilts, are betting the sort of momentum trade for a 14th month in a row.
Every day I come into work thinking this is a serious program, and I'm constantly reminded.
Whoa.
It's not.
You do? When did you ever come in thinking
delusional
this is serious?
for the first 5 minutes of my morning? It's going to be a serious day. The payrolls report, 5 minutes away. Equity futures on the S&P, just about positive. Your estimate this morning, 195,000. The print up next.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Let's call it 22 seconds away from the payrolls report in America. The stage set like this going into the print. Equity market futures are positive on the S&P 500 by 0.4%. Yields on a 10-year a little bit higher by a couple of basis points. On a 10-year right now, let's call it 361. On a 2-year higher by 2 basis points, 436. The number we're looking for, 195,000. With the jobs number, let's get to Mike McKee.
Well, good morning, guys. This is one for the Hawks. If you were thinking the Fed might not raise rates, 339,000 jobs created during the month. The prior month was at 253 unrounded. We'll see, or unrevised. We'll see what that looks like in just a moment. The unemployment rate, though, does jump up to 3.7% from 3.4%. So there's a good question for Randy, is which one is the Fed going to look at more closely? Average hourly earnings come in at exactly what was expected, a 0.3 rise. The year over year only goes to 4.3%. That is a tick lower than the Fed had expected and consensus had expected. Average weekly hours, 34.3. That is down a little bit from the prior month. And the labor force participation rate doesn't change, 62.6. Total revisions of plus 93. I'll get you the breakdown of what months those came from. But again, the big number, 339,000. And if you're the Fed and you're thinking that the labor market is going to slow down, you're going to be disappointed in that number.
Mike McKee, there's something for everyone in this. Let's be clear about that. I'm going to whip through the price action. The initial debate around this table will be 339 screams, let's go again in June and hike once more. The rest of the character of the labour market report this morning, less convincing, and we could talk about that in a second. Let's see if this move sticks at the front end of the yield curve. The 2-year at the moment higher by 8 basis points. The 10-year yield higher by 4 basis points. Clearly, that move in payrolls on the headline number shaping things. That's the early move. I say this almost every single month. Let's see if that move sticks. That's the bond market move and the equity market. Equity futures not really doing much. The S&P 500 positive by, let's call it 0.4% on the S&P. And just to turn to foreign exchange off the back of those high yields, the dollar's showing just a touch of strength. Not much, just a little bit. On the euro against the dollar, 107.54. We're negative there by about 0.1%. Mike, you've had a bit more time to pour through this one. I think a lot of people might have the same question. Well, hang on a minute, Mike. The headline number's massive. What's happening with unemployment? What's happening with wage growth?
Taking a look at the unemployment rate, the number of unemployed rose by 440,000. The number of employed fell by 310,000. And the labor force grew only by 130,000. So this is definitely a story of more people losing jobs than getting jobs, which is kind of a different story from what we had seen in the unemployment rate over the past couple of months. We do have that gigantic job creation number. And a lot of that is, according to the BLS, is in professional and business services, 64,000 jobs. And that was an area that the Fed and others had been looking at because when you start to see hiring slow down, it's usually in the temporary help services, and those had been slowing down, but now we get a rebound there. Government employment up 56,000 in May, so that was a big contributor. And as usual, healthcare and leisure and hospitality are adding a lot to the level. Construction, interestingly enough, 25,000 jobs, which we had seen in the JOLTS report this week that there were a lot of open jobs in construction, and we're still seeing home builders putting together a lot of work. So it looks at this point, manufacturing, by the way, lost 2,000 jobs, but it looks at this point like still strong job creation, but we're seeing some of the numbers in terms of household tick up.
John, I'm looking at 420,000 plus with a revision, the 3 months moving average, my first math on it. With Dr. Krauser next to me, I really got to be careful here. It's going to be a quality C, 283,000 3 months moving average.
Can someone in the control room get Governor Jefferson on the phone? Can we have a conversation about whether it's still a skip? Bramo, how do you interpret these numbers? 339, big. Then elsewhere, if you took that away and looked at the rest of the report, what would you say June was going to be?
I really can't understand these numbers with a cohesive story, except to say that perhaps the numbers don't tell a cohesive story. What you're seeing right now is greater than expected hiring, and yet a weakness underpinning this that really speaks to the increased layoffs that we see anecdotally. So a real churn that isn't necessarily positive, leaving the unemployment rate at a higher pace. The fact that there is not as great of a wage increase on a year-over-year basis speaks to a lack of momentum there that the Fed's going to lean into, especially with skipping over the past month. I don't understand, though, how we can get these upward revisions, how we can get one blockbuster number after another and then call this a weak economy. It's confusing.
It's kind of the story of the last 4 or 5 minutes in the market as well. Leaning into the headline number, big beat, yields up, dollar stronger, equities pull in just a little bit. But as we have more and more of a conversation about the rest of the report, the move at the front end fades. I can tell you with the front end now higher by about 4 basis points. And I know I keep saying this, but bear in mind, it changes so often. You get the initial report, the market reaction, then things fade as the session grows a little bit older. So up at the front end by about 4 basis points. The euro almost unchanged now on the session. Equity markets on the S&P 500 almost at session highs, positive by 0.5, 0.6%. Mike, wonderful to catch up with you. We'll catch up with Mike a little bit later, I'm sure. We'll do that in the next hour as we count you down to the opening bell as well. In the next hour on Bloomberg TV, fantastic lineup to go through these numbers. Mohammed Al-Erin of Queen's College, Cambridge, Rick Reeder of BlackRock, Anastasia Amoroso of iCapital, Mike Collins of PGIM Fixed Income. TK, just to break down what we've heard in the last 5 minutes or so, push it through this market and talk about CPI on the 13th. The Fed on the 14th.
To me, it's a terrific, terrific jobs report. It'll be interesting to see what your team says at 9 o'clock as well. With us again with Michael McKee is Randall Krosner, professor at the University of Chicago Booth School and, of course, a former Fed governor. At least I thought captured it beautifully, Professor Krosner, the confusion we have, the movable parts of labor that is in any labor economics textbook. Which movable part of the American labor economy matters to you right now?
Well, probably the piece that matters most is what's happening to wages. And so that the Fed can take a little bit of comfort in that despite the very strong numbers the headline numbers that we saw in the upward revisions, we're not seeing an intensifying wage pressure. But that's going to be really the key that the Fed will be looking at, because that's what feeds through to costs of services and then CPI, PCE, all of the implications for where inflation's going and cost of living.
This is messy data. This is really messy data right now, because it's not just with respect to headline numbers. It's also the compositional story here. Which jobs are being added? Are they lower income jobs? Is that what we're looking at? And then what does that say about wage gains? Does that really give you an apples to apples comparison? Is part of the reason why data dependency is taking on less importance simply because the data is too messy to really read in any kind of clean manner?
Yeah, you bring up a very important point because it's really important to unpack those numbers and look at the composition. Is it that, where are the layoffs happening? Are they happening at the lower end of the income spectrum? Or are they happening at the higher end of the income spectrum? Because that makes a very big difference for what average wage growth is going to be. So important to unpack that. Undoubtedly, that's what the people at the Fed will be doing. But we'll see. I think my guess is this will be consistent with a skip. But one never knows.
We're going to have with us Randy Krosner. We're going to continue with Professor Krosner here in a moment. Again, a lift to the equity markets off of where we were before the report. The VIX is stunning, 15.32. To imagine a 14 VIX will be extraordinary. Two-year yield out 5 basis points as well. Oil with a bit of a rally, off, I should say, from the jobs report. Dollar weakness this morning. Professor Krosner, I want to go narrow on you now. I can do this because you're so damn good at this. But the answer is, there's been angst over the last 10 days about the revisions that Mike McKee talks about. Nobody trusts him. Jack Welch, the late, great Jack Welch of GE, didn't trust Bureau of Labor Statistics and all that. There's a thing, the birth-death adjustment to all of this statistics. Explain how experts like you are not worried or don't have the angst that we have in the birth-death study.
So I think just stepping back, bigger picture, I don't think these numbers are politicized. I do think they try to do the best job possible. But it ain't easy every month trying to come up with the total number of workers in the economy coming in, coming out. And so you have these challenges of seeing, well, what are new firms coming in? What are firms that are exiting? How well do you cover those? And that's one of the issues that comes up. So when there's a lot of churn in that part of the market, which there is right now, you can get some of this volatility.
As you take a step back, especially with the upward revisions, can we make some assumption that perhaps there should be an increased pricing of further rate hikes down the line, that perhaps Citigroup's Andrew Hollenhorst is more right than some of the people who are saying that there are going to be rate cuts starting in September?
Yeah, I don't see any evidence for rate cuts coming anytime soon. Now, there could be some sort of geopolitical event or something extreme like that happens. But for that, the Fed is going to hang tough. They remember what happened to the Fed in the late 1970s, early 80s, when the Fed pulled back too quickly, when they thought, we've vanquished inflation. They didn't. Inflation went back up, and then they had to raise rates to double-digit levels. They don't want to do that. They'd much rather move things up to the upper fives rather than take a long pause and then have to go to 8 or 10.
How high is the threshold right now to cut?
Oh, I think it'd be very, very high, unless there's some sort of miracle where we get this immaculate disinflation and inflation just falls like a stone, which I have seen no evidence for. They ain't going to be cutting anytime soon. It's
a beautiful chart. We're not going to show it today with all the moving parts here, but if you look at the standard deviation of American unemployment, 3.7% is still an act of God. Michael McKee has parsed through all the data. 3.70%, Mike, we're well within the center tendency of the post-pandemic trend. In your mind, what's the level of unemployment where we begin to change this dialogue?
Well, I think most people at the Fed have said you got to get at least over 4.
And we're
four has been what they considered sort of the neutral rate for a long time, and we've obviously been below that. But even at 4%, that's lower than it was a couple of years ago in terms of what a neutral rate would be. So I think there's certainly scope for them to fall more. Now, interesting decomposition of the unemployment rate. We had seen a lot made of the fact that black unemployment had fallen to the lowest ever. It has jumped up significantly, almost a full percentage point, 0.9% higher than it was in the last report. So at this point, we're looking at 5.6%. So a big increase in black and African-American unemployment, which is not necessarily a good thing.
Just joining us, Markets on the Move. Lisa Bramwitz and Tom Keene. John getting ready for the next hour. Randall Krosner with us from the Booth School, Chicago. Michael McKee with all of his abilities as well. Coming up, Ira Jersey will join us in the bond market. Gina Martin-Adams on lifting equities to the moon. She has said participate in stocks. And Jeff Rosenberg has summed all this together at BlackRock and joins us right now. Jeff, I'm going to ask you a Krosner-like question, which I'm sure Carnegie Mellon, Carnegie Mellon economics, right?
Yeah.
It's like first-rate stuff. Jeff, I'm going to ask you here about the bombshell from John Williams a couple days ago, which is R-Star stays lower which I believe signals a shift lower in interest rates. Are you investing at BlackRock presuming lower yield, higher fixed income price?
Well, it's really been a story of quite the opposite, Tom, right? It's about...
I think we have a frozen Jeff Rosenberg. I think we
Sorry,
lose you.
no.
Okay.
I'm still here. The producer was just in my ear there for a second. It's been going in the opposite direction. Obviously, it's about higher interest rates, and we've been investing along that way, as he talked about in terms of the curve. We're facing an inverted yield curve, and so the highest interest rates are in the front end. The long-term R-star story is really about whether or not policy is tight right now. And, if R-star is, as Williams laid out, then, policy is tight. And that's what the Fed believes, and that's why they're taking a pause. What today's labor market report sort of says is, where's the tightness? You've raised interest rates 500 basis points. We're still delivering 300,000, over 300,000 jobs. So the disconnect here is that you're not really seeing the slowing in the labor market. Where you're seeing the slowing is in the goods producing part of the economy. And the split in the outlook is goods and survey-based data on goods is at recession type level, but services are holding in just fine. So Randy said earlier, you got to look at the details. One of the details that sort of sticks out here is a turnaround in the goods producing areas of the economy in terms of hiring. That's a little bit worrisome for the Fed and the inflation, because all the disinflation is coming from the goods. And so if goods prices are stabilizing and goods hiring is increasing, which is what we see in this report, then you may have the consensus outlook here, which is focused on these NAPM surveys, the PMIs, we got it earlier, the ISMs, collapsing into recession levels. That may just be a nominal effect. And is really not telling you the story. And for the Fed, it's a pause or a skip. Sorry, it's a skip. And then, a couple of more strong reports. And it may not be that the rates and the real rate is as low as Williams thinks it is, because you're not getting the effective tightening.
Jeff, I keep wondering whether people have gotten too sanguine on the idea of inflation coming back to that 2% level of the Federal Reserve. And I'm looking right now at break-even rates, 2.2% over the next 5 to 10 years. Do you think that the suggestion here, with a skip by the Fed and a hot labor market report, suggests a stickiness and a resilience that is not priced into this market?
Well, it's certainly not priced into the break-evens. They are reflecting the immaculate disinflation. And, the evidence hasn't really shown anything to support the immaculate disinflation. So there's very much a hope trade going on here in the fixed income market in two factors: the hope that inflation immaculately falls, and then the second implication of that is the Fed's going to be able to go back to its old playbook and ride to the rescue of asset prices and asset inflation, and cut interest rates by the end of this year, which is, again, you just don't see anything in the data that supports that. So I think this report is a little bit challenging. Yeah, the unemployment rate helps a bit, but it's a very noisy data series. And so we'll have to see there.
Randa Crosman with us, as well as Jeff Rosenberg, and again, we'll get to Ira Jersey. And Gina Martin-Adams on this stock market that won't quit. She's been very good about that. Professor Crosner, I want to go back to Frank Knight, the advent of the Chicago School, and it came out of something I got totally wrong, which was my grandmother talking about the pandemic of 1918. We used to laugh at Grandma. We laughed at Frank Knight and everybody else who had to live that pandemic. We're coming out of our own pandemic now. Can you practice the evil trade of labor economics now? Or is there just too much uncertainty to know what's going to happen forward? Surprise after surprise after surprise. Do we really know what we're doing?
Well, I mean, obviously, we don't have pandemics all that often, and so so you've got two main data points, the recent one and one from a century ago. So it's hard to make sure that you've got your models really well calibrated. But that said, I think we see some general characteristics that make sense. As we were talking about before, you're going to see lower labor force participation by older workers. You're going to see a reluctance of people going back to the office. So I think those things are sort of broadly predictable. But this strength that we're continuing strength in the labor market, but for 500 basis point increase by the Fed, that is pretty surprising.
I mean, you take the Jeff Rosenberg across the century here from pandemic 1 to pandemic 2. Frame with your fixed income view, Jeff Rosenberg, the distance from Goolsbee to Bullard. Right now, it seems extraordinary.
Yeah, there's a long way to go here, and as Randy just echoed, 500 basis points is a big increase, but there is the other school of thought on this real interest rate that the pandemic ushered in, some significant structural changes that effectively raises the real interest rate, and if the real interest rate is actually higher, then the Fed nominal interest rate has to be higher in order to get tightening in. Now, we just have to be in this period of uncertainty, and it may be long and variable lags, and it's just around the corner, and labor markets can change very quickly, and we can, get into negative numbers on the headline payrolls, and then the Fed will be justified in the skip. But the lack of momentum, the lack of evidence on making any of that progress, and the longer that proceeds, sort of starts to push on the other argument that you really have had a structural change here. You need a much higher interest rate. There's less interest rate sensitivity. And the other big thing here is the balance sheet and liquidity. And perhaps we'll look back on this period and recognize that, it wasn't about the interest rate. It was just that you had this legacy of excess liquidity that you had to wait to get that liquidity out before those interest rates started to really bite. And if you waited too long, perhaps that allowed inflation and inflation psychology to take hold, and that would be where we go. But that's one potential path.
Just real quickly here, Jeff, given the uncertainty and given the inability to really get an edge on data that's moving quickly and that really has defied a lot of expectations, what are you pushing back against? Where do you get conviction in terms of market positioning, given that there are so many question marks around some of these big parameters?
It's really hard. There's very little conviction. If you take this consensus view, 65%, 70% probability of recession in the next 12 months, it's recession is the consensus. And, you look at a report like today, you look at how well financial markets are holding up in terms of beta and returns. Yes, there's a big AI and tech, and we're back into tech dominating, 7 stocks that make it. But, there's not a lot of recession risk priced into the financial markets. Look at credit markets and credit spreads. They're at mid-expansion levels. So if you're going to push back anywhere, I think the pushback is this kind of 70% consensus probability of recession right around the corner. And that's the issue, is it's just not right around the corner. That's what this report tells you. It's pushed out further and further. It's the long and variable lags. So that time dimension is, I think, the thing you push against.
Rosenberg and Krosner pushing up the 2-year yield 10 basis points, 4.44%. Krosner never did that when he was at the Fed. Professor Krosner's with us. Jeff Rosenberg, thank you so much with BlackRock today. Really look forward to hearing from you through the month of June. Just because of time here, folks, Ira Jersey is going to go back with Bloomberg Intelligence and write up this important note for terminal users worldwide. We're going to jump to the equity markets right now. Gina Martin-Adams joining us here. Gina, I sort of said this on air, but I said it much more off air today. Are we on the precursor of a melt-up, which is basically due to obvious short covering and far more just a general caution out there I hear in every conversation on the stock market?
I think you've hit the nail on the head, Tom. What's happening in the equity market is that everyone was expecting a recession. As of late last year, we were pricing a material recession emerging in both the economy and earnings stream. And all of the data so far that we've had this year has only surprised us to the upside, including within the S&P 500 earnings results of the first quarter. Analysts were expecting a greater than 8% decline in earnings year over year in the first quarter. They got a 3% drop. Many companies actually started beating expectations. What I think we're seeing right now is the effect of slower inflation now starting to prove out as margin stability in the S&P 500. And that's actually brightening the outlook for earnings, even while most of the narrative is still surrounding this economic recession that we've all been waiting for. The earnings stream is showing that the S&P 500 is about to go through some form of a healing process. So that creates a lot of moving parts in the index. You see some stocks certainly celebrating the better news out of the earnings stream, as well as hopes for better earnings going forward. Other stocks still struggling with the economic weaknesses evident in the goods industries, but it is a lot of moving parts. Net, I think the result is we were expecting a very big drawdown. We're not getting it.
Gina, those better than expected earnings in equities, are you seeing that accompanied with more job cuts, with more general cost savings, or is this actually encouraging more hiring that flies in the face of an unemployment rate going up materially?
Oh, I think that's an excellent question, because what we detected actually is the peak job cuts occurred in the fourth quarter of 2022. And even when we look at sentiment towards labor imbalances within the S&P 500 transcripts, we actually see S&P 500 companies talking about labor imbalances now not as much of an impediment to growth going forward. If you look at actual job cuts and announcements, if you look at initial claims that resulted from those job cut announcements, we saw job cut announcements peak in the fourth quarter and early first quarter. They've actually started to trend down slightly. We saw initial claims then lag that peak with a peak over the March-April period, and initial claims have even started to downtrend a little bit. So what we could be experiencing is this very lumpy experience in the S&P, really focused on the tech sector layoffs, the communication sector layoffs, some additional financial sector layoffs. The groups that were excessively employed as a result of pandemic conditions have now laid off workers, and they're telling us that their conditions are improving going forward. They now feel like they've generally right-sized their labor force, in particular in tech and communications, which really led us into this weak period. Those groups are telling us that they've right-sized their labor force. They're feeling a little bit better about their sort of demand versus supply dynamics, and we've got a more stable environment for 2023 relative to 2022.
Randy, this doesn't sound like immaculate disinflation. This doesn't sound like what the Fed wants to see, even if they do skip the next meeting, although people are kind of questioning that a little bit more after getting some of these numbers. Do you think that people have written off this idea of inflation being stickier and frankly had too much confidence in the Fed's conviction? I know you're saying that they're going to hold rates higher, but we haven't seen the pain, and they're already talking about the balance of risks to the downside, and you're not seeing it in the economic data. Are you concerned that this Fed is not taking the longer-term risk of inflation seriously enough?
No, I think they are. I think that's why they raised rates so rapidly and at such with such big steps. Now, I think taking some time to assess, given the long and variable lags, that seems perfectly reasonable. But they made it really clear that just by skipping or taking a short break doesn't mean that they're going to be cutting.
So do you think that they could get to 6%?
For sure. If inflation continues to be persistent as it is, I mean, we saw both the core and headline personal consumption expenditure index, the PCE, which is what the Fed focuses on, that ticked up. That didn't tick down. And so it certainly came a lot down from its peaks, but that's what the Fed's going to be looking at. And if we're not making progress there, the Fed's going to have to keep at it.
We're going to spend the rest of the time with you. Gina, I got one question here. When does tech break? Can you give it to me within a day or week here? When does tech finally break at Bloomberg Intelligence?
You know, I think honestly, Tom, when you look at the sequence of what's happened so far this year, it's not just about tech. I understand that we were really focused on the biggest 5 stocks in the index, but it really is an accumulation of growth stocks recovering after last year's weakness. So it's tech, it's communication services, consumer discretionary. All three of those sectors have led the charge so far this year. Yes, there is a heavy, higher market cap concentration tilt to that, but the sort of reality of what's going on in the S&P 500 is the losers of 2022 have become winners in 2023. The winners of 2022 have become losers in 2023. And it's very consistent with what we're seeing in the earnings trends.
Gina Martin Adams, Ira Jersey, thank you so much. Ira, so sorry we couldn't get to you today. We've got Krosner on set, so we're going with that. I want to get one in here, and Lisa, I know, wants to jump in as well. There are people that say this chairman has failed and he should go. Defend Jerome Powell.
So I think all central banks around the world were too slow to pick up on the persistence of inflation. Fed was talking about it as transitory. Other central banks were talking about it as transitory. They shouldn't have been doing that for as long as they did. I could understand for the first few months, but by the fall of 21, they should have kind of figured that out. So I think that's an issue. However, I think the Fed has done a good job of pivoting and saying, okay, inflation is our main priority. We've got to move rates up. They've moved rates up very significantly. I think a success is that inflation expectations have not become unanchored. That was the main concern, because this is what happened in the late 70s, early 80s, when the Fed lost credibility, and that's why they had to raise rates to double-digit levels to bring inflation down. So far, the inflation rate has come down without the Fed having to grow too far, but we'll see. I mean, you know, you often ask me to give people grades. Obviously, this has to be an incomplete.
I love the D you gave me.
I'd never give you a D.
Lisa from the University of Chicago, jump in here with a professor with a final question.
Well, you were talking about the potential to raise more, and I think perhaps there's another question. Are people underestimating the duration of the Fed holding rates where they are? And will that potentially be something that's more dramatic than even raising rates further, which could accelerate a break and then some sort of retracement? The sort of drip, drip, drip of deposits out of banks. Have we seen the full effect of that on lending?
So I think for sure I think that's one of the reasons why the Fed wants to take a little bit of a skip right now, because I think they want to step back and assess what's really going on with the banking system and with credit flows. We've seen more and more reports that small and medium-sized banks are are pulling back, and that small and medium-sized business are finding it more difficult to get credit, because you have the combination of the higher rates and then pull back in credit. That's going to make it much more difficult for these jobs to continue to be created. And so I think that's why they want to skip now.
Doesn't it just, you begin to tear up when the Chicago law student nails the x-axis analysis versus the y-axis? I mean, it's like, it's in the ether at Chicago, isn't it?
For sure.
She crushed it with that question. No question about it. Randall Krauser in studio. We're going to make this a monthly thing to have Professor Krauser with us. Truly wonderful former Fed governor, of course, with the Booth School of Chicago. I don't know what to say after month after month after month. You never know what to expect with a jobs report. I expect the VIX 15.30, a 14 VIX. This is Bloomberg. Good morning.
And we get another one, another big payrolls beat, a complex report that we need to figure out through the next 60 minutes or so. Equity futures positive on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York coming up, jobs growth in America defying the gloom as the Fed gets one more last word before going quiet. The debt limit deal heads to the president's desk. We begin with the big issue, a week of contradictions. A big increase in job vacancies, jobless claims still ridiculously low, all backed up by strong payrolls growth, contradicted by numbers elsewhere in the jobs report, another weak read on U.S. manufacturing, and a long list of retailers warning about a struggling U.S. consumer. The Dollar General CEO saying their customers are relying more on food banks, savings, credit cards, and then Macy's boss indicating they planned the year assuming that the economic health of the consumer would be challenged, but starting in late March, demand trends weakened even further. All of this leaving the US Central Bank dazed and somewhat confused ahead of its next policy meeting. Joining us now to discuss is Mohammed El-Erin of Queen's College, Cambridge, and BlackRock's Rick Reeder. Mohammed, first to you. We've got to figure out what on earth is this payrolls report this morning?
So the 14th straight upside surprise. Now there's 20 out of 21 upside surprises. Look, the U.S. economy remains a major engine of job creation, and that is good news. We also know that the U.S. economy is increasingly dualistic between what's happening in manufacturing in general and what's happening in services. And all this, including today's job reports, complicates the Fed's policy challenge, whether you call it a skip, a pause, or hike. It certainly complicates it. And I must tell you, it's going to amplify already the high criticism about communication. People are now going to be scratching their head. Why did they guide the market so strongly towards a skip ahead of this report and ahead of the next CPI?
Rick Reeder, your first take, please.
So, I mean, listen, 339,000 jobs, a lot of jobs. I continue to say, if you go to these component parts, and we talk about this every month, leisure and hospitality, education and healthcare, you're seeing, I mean, they're still not there yet in terms of there's still a tremendous number of workers that have to be hired in those spaces. They're still below the trend line post-COVID. And so that, I think that is persistent. I still think you'll see more of those jobs come in. There's a very interesting nuance to this. You're getting functionally all the job growth you're getting, or the supply of the labor is coming from international, from immigration. And that's part of, you're seeing wages that are coming down a little bit. We're expanding that labor supply. I mean, it's something that you think about what has to happen in UK and Germany, et cetera. But that's a big deal. We're hiring a lot of people, and it's coming from international, because you've seen a lot of people leave the labor force that have retired. So that is encouraging. But listen, I think, I still think we're going to be I think the Fed getting to the 4.5 unemployment target or what they've projected is hard.
Mohammed, you mentioned some of the contradictions. I talked about them as well. Let's just dig further into this labour market report as well. The headline number on payrolls, Mohammed, is screaming go again, hike once more in a couple of weeks' time. The rest of the report, Mohammed, does it contradict that to some extent? We get two surveys here, establishment, household. Are they telling you two different things?
Oh, they are. But if you look over time, if you were to take the whole series, then they're telling you a pretty consistent story. And they are telling you, as Rick rightly said, that you have a dualistic economy, that we continue to be strong in terms of labor demand, and we continue to create jobs. Fortunately, the supply side is responding, as Rick said. But the Fed is going to have to make a really difficult judgment. Does it expect the supply side of the labor market to continue to allow wage growth to remain very muted, or will it worry about what the JOLTS data told us? So this is tough. This is getting really tough.
Yields up at the front end by 7 basis points, 441, slightly pricing back in a prospect, the risk, the potential, probability that maybe we do get a hike a little bit later this month. Mike McKee dropping by the studio, guys, to catch up with us too. Mike McKee, you've had about 34 minutes to explain this one. What is the explanation?
It's not a particularly good explanation. It is quite a divide between the household and the establishment survey. The establishment survey, as you have been talking about, comes in at 339,000, and April was revised up significantly to 294,000. So still very strong hiring, at least from the company's point of view. And then you have that establishment survey that shows a big drop in the number of people who had jobs, and the unemployment rate goes up to 3.7%. How do you square those two? The average hourly earnings comes in pretty much bang on estimates, although on a year-over-year basis, down a tick to 4.3%. But it still suggests, as you did, John, that it's a bifurcated jobs market. We're seeing strong hiring, but the other categories could give an opportunity to the Fed if they want to hold or skip this month. Interesting, in construction, we saw a big gain, 25,000 jobs, and a lot of that is civil construction. In other words, is the Biden IRA plan actually starting to contribute to growth now? Is construction turning around, not just residential, but for the big infrastructure projects? Government, 56,000. You wonder if that's a seasonal thing, because a lot of hiring for schools reported, but schools are getting out in the month of May. Professional services, interesting, because usually that goes down when you're going to see the economy slow. And leisure and hospitality, our favorite category, as Rick was saying, still adding. So where does it leave the Fed? Interestingly enough, the WIRP function on the Bloomberg now shows a 40% chance of a Fed move. Yesterday, it was 23% in June. And here's the lineup. Now, I put the new title on there because really we saw Phillips and we saw Harker say this twice, but it only got Wall Street's attention the last time they did. They haven't really changed their views. And here's kind of the lineup, and the ones who are bolded there are the ones who are voters. So it's about even at this point. Be interesting to see how, if at all, this report affects their views.
Mike McKee, thank you. President Harker, we should skip this meeting. Governor Jefferson early this week, skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. Mohammed, if we got Governor Jefferson back on the phone, do you think the message would change?
I don't know. I mean, I smile a little bit because thinking that 1 month of data is going to make a huge difference is, I think, fooling yourself. But they have framed it that way. And it's a shame because I think it's such a narrow framing, John. We're all now discussing, is it a skip, is it a pause, when there are such bigger issues involved. And that's the risk of being excessively data dependent, is that you get stuck in a sort of smaller and smaller corner, and the data will pin you there. And as the data becomes fluid, it pins you there even more. You've heard me say over and over again, we need a strategic view of this economy from the Fed, and they need to know where they want to end up, because right now they're excessively data dependent.
Going into the June meeting, Rick, going into this morning even, there was a feeling that we had de-emphasized incoming information going into June because they started to coalesce around the view that they could skip this meeting. I don't think this morning I know what to do with this data when I push it through the bond market, Rick. The market initially sending yields higher by 6 basis points on a 2-year to 440. Others might be looking to fade that. Rick, how are you thinking about that? Have we reintroduced a higher risk now that they do go this month?
Yeah, I mean, I still think I think they're going to pause. If you gave me, but it's not that clear, and we've got CPI report to see. So, and which, by the way, we think is going to be a firm number. So, listen, I think you can pause. I mean, you've moved rates 500 basis points. You will start seeing credit contraction. And people say, when you look into the numbers, I mean, we see it through our platform. All of a sudden, the financing dynamics around where the banks used to lend, we're now being asked in a bunch of different places. You're going to see credit contraction. And the thing I throw out there, we talk about the components of this job report. You lift interest rates, and it hits the cyclical parts. What's clearly slowed is the cyclical parts of the economy. But Mike McKee said construction is different because of the infrastructure build that's going on. But gosh, are you going to really impact healthcare and education hires? Not really. And the question is, can you pause? Can you watch some of this data play out? The data is, the economy is normalizing, and you see it. Is it slower? In inflation terms, it is. But boy, we're going to get more data, and I think it's going to tell you economy's normalizing to a more moderate pace, and you can take some time with that.
And in the meantime, by the NASDAQ, Rick, this rip-roaring rally we've seen in the NASDAQ 100, I think this is week 6 consecutive weeks of gains, and this morning NASDAQ futures up again. Big time and doing nicely going into the opening bell. Rick, at the start of the year, it was all about there is an alternative. There is an alternative. You can go to T-bills, money market funds, pick up 4 or 5%, do what you will. And now it just feels like the fear of missing out is kicking back in, Rick, into the equity market. Do you feel some of that?
100%. I mean, we've led, I'll tell you a couple of things that are interesting around the equity market. The volatility, you look at the VIX index, I think on the prior show we were talking about it. People are not long. It's the reason why volatility is priced so cheaply. People don't need to buy insurance because they're generally not long. You see that in high frequency data. And so, by the way, it's been you can build a portfolio to carry a lot of income and then buy upside convexity in the equity market and can ride some of this move. I think the technicals in the equity market are really good. By the way, you're not getting a lot of issuance. Companies are buying back their stock, and people aren't long. You've got this incredible technical, and there's an interesting flight to quality trade going on here. You look at the big tech companies. We people talk a lot about AI, which is true and sincere. But there's also, boy, you look at the cash flow generation. You look at, it's a bit of a flight to quality trade in a lot of these companies that's going on. That's not terribly different than keeping some income in the fixed income market in the short end of the yield curve. One man's bull market, another man's bubble, Mohammed. I'm trying to work out which one it is. I guess it depends whether you're in it or outside of it on the fringes watching it.
So I'm with Rick. Look, the equity market benefits from what I call the notion of all-weather stocks. Stocks that are viewed as either riding a huge secular wave, or alternatively, stocks that are viewed to be insensitive to economic and financial fluctuations. And they have led the rally. In a way, I think equity market participants are very lucky. I feel sorry for the fixed income participants. Imagine we have a Fed policy meeting in less than 2 weeks, and in the last 3 days, the probability of what will happen at that meeting was, as you heard Mike correctly say, 60% hike, down to 20% hike, back up to 40% hike. That is the world that the fixed income people are having to navigate. So relative to them, the equity market looks really very steady and sort of easy to navigate.
Mohammed, if only things were that easy. You've complained about the Fed not taking a strategic view. As a market participant, can you take a strategic view on the direction of things?
So I worry, John, that this Fed will end up pushing the economy into recession. I worry that this will happen for the 3 reasons you know. One is the lack, not just of a strategic view, but of a valid monetary framework. 2 is I think they have the wrong inflation target. And 3, they're trying to restore their credibility. So that's the concern. Otherwise, I think it will be easier to navigate, but the risk of yet another policy error, I fear, is quite high.
Rick said pause in June. That's his expectation, not his recommendation. Mohammed, when we spoke last week, before we had this data, your expectation was rate hike in June. What is it now?
So if they are serious about their 2% target, given the data, they should hike. Okay, if they are true to their word, they should hike because they are data dependent and the data has been hotter than expected. The surprise index, John, is at levels we haven't seen for a very long time, pointing consistently to stronger than expected data. So if they are true to their word and true to their target, they should hike. I would not hike, but then I have sort of broader issues, as you know, in terms of how I would be thinking of monetary policy here.
Mohammed, Rick, you're going to stick with us, I'm pleased to say. And the equity market right now going into the opening bell, equity futures just about positive on the S&P 500. Let's get you those movers. We can get to Abby. Hey, Abby.
Hey, John. Well, we're looking at the best day in at least 3 years, I believe, for Lululemon after they put up a big beat and raised quarter. Their adjusted earnings were 16% better than estimates, sales 4% higher. The full year outlook was raised. China is strong and high-end demand staying in place. So the conundrum of different levels of retail continues. MongoDB, the database company indirectly related to AI, they put up adjusted earnings of 56 cents, 200% better than expected. Sales beat, they boosted the outlook, huge upside ahead according to some analysts. Those shares are soaring. And then finally, rounding it out, Cliffs Natural Resources, or Cleveland Cliffs, up 5.3%, the best day since early January. Iron ore is up 2.6%. Steel rebar is up more than 1%. That stock is rallying.
Abby, thank you. China, a massive part of this conversation we'll get to in just a moment. Coming up, the debt limit deal clearing the Senate.
This demanded a bipartisan solution. We knew we'd need to come together for a solution.
The deal the House passed last night is a promising step toward fiscal sanity.
More on that and another big payrolls report with Mohammed Al-Arian and BlackRock's Rick Reeder.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
On this vote, the yeas are 63, the nays are 36. The 60-vote threshold having been achieved, the bill is passed.
63 to 36, the Senate passing the debt limit deal with ease.
This demanded a bipartisan solution. We knew we'd need to come together for a solution like the one that passed tonight. And so I'm happy to stand here passing this critical legislation to support our families, preserve vital programs, and most importantly, avoid catastrophic default.
The deal the House passed last night is a promising step toward fiscal sanity. But make no mistake, there's much more work to be done. The fight to reel in wasteful spending is far from over.
The President thanking Schumer and McConnell, calling the agreement a reminder of what's possible when we act in the best interests of our country. I look forward to signing this bill into law as soon as possible. The President set to address the nation this evening from the Oval Office. Joining us now, Bloomberg's Anne-Marie. Morning, Anne-Marie.
Good morning, John. That's right. The president will address the nation this evening, talking about the debt ceiling deal that he got through Congress through a bipartisan fashion. Late last night, it was finished in the Senate, really through the moderates of both parties. One way that Senator Schumer and Senator McConnell were able to assuage some senators' concerns, especially on the GOP side when it comes to these defense hawks, is that they said that this bill does nothing to limit what they can appropriate in emergency spending fashion. So potentially, Jonathan, not quite the exact spending fiscal restrictions we will see if you start appropriating more funds through supplemental means. But this would be a win for the president. And I imagine this evening he will also address what we saw this morning when it comes to those non-farm payroll.
A win for Speaker McCarthy as well. Big win for the president if he wants to talk about the headline number, but elsewhere, slightly confusing. AMH, thank you. Down in Washington, D.C. Rick, onwards. We move on. Hundreds of billions of dollars of T-bill issuance just around the corner. Do you see that being a problem?
There's no, it's funny. I always think, we've all been talking about this debt ceiling. Markets can only do one thing at a time. They can only focus on one thing. Now you just hit on the thing that I think is significant. We're gonna drain $1 trillion of liquidity from the system in terms of bill issuance, $500 billion to replace to replenish the TGA. It's a big deal. I mean, that coupled with the Fed, that is significant. When you drain that much liquidity, it's symmetric to QE. You watch how markets move relative to that. The one thing that I think is different than that draining of liquidity, people have been sitting on their hands for a long time because of all the risk, debt ceiling being a big part of it. There's a lot of money in this system that I think will be able to absorb this, but it's going to be a big focus for the next couple of 3 months.
Mohammed, what does that T-bill issuance compete with directly?
So it competes with what depositors in banks will do otherwise. I mean, what will tend to happen is attract more money out of banks into money market funds. Look, John, there's two things to watch. One is how they are absorbed, and two is market functioning. I'm pretty actually optimistic on both sides that it will be able to be absorbed and the market will function well, but keep an eye on that. More generally, John, and we've taken now two headwinds out of the way. People tend to use the word crisis inadvisably. So people talked about a debt ceiling crisis and a banking crisis.
Yeah.
Well, both crises, which never were crises, as you know, but both of them have been taken out of the way. They're no longer headwinds to the economy.
You
or to the
sound
market.
almost constructive, Mohammed, on equity markets in a way that I haven't heard you sound like this for a while.
Oh, no, for weeks now I've been saying these are fairly priced for what we don't know. Okay, I've always felt that we would resolve the debt ceiling issue. That was the working assumption for most people. They will get resolved, and it has gotten resolved. It's not going to materially change the economic outlook, but there's lots of issues that we don't know, including what we talked about earlier.
A lot of people are in cash, Rick. You were in cash. You've slowly chipped away at that. I think we've been tracking your cash pile over the last several months. Where is that cash pile now, and Rick? And I think we need to talk about that moment for a lot of people who went to cash 4 or 5%. The decision to go to cash is the first call. The second call is to get back out of it. And I think we often say the second call is the harder decision to make, Rick. What's your advice to those people sat in T-bills right now, sat in cash?
I'll tell you, I would still own a bunch of them. I mean, at the end of the day, this is a pretty, you made the point about, for fixed income, it's a tricky period. It is a tricky period, but there are a couple of things that I think are really powerful. One is you can carry really high. You talk about this bill issuance, you're talking about buying, you can buy 1 to 3 year maturity investment grade credit. by the way, in Europe, swap it back to dollars, get over 6%. That's pretty good. I mean, you're not taking credit risk. You're not taking really any significant interest rate risk. So you can do, so there's that to do in the markets. And I think people, will continue to put money into these, to what are some pretty significant yields that you haven't seen in the past in quality assets. And then the second thing, Jonathan, that I think is critical, we lived for 10 years in zero rate environment or low rate environment. And financial assets became potatoes. It didn't really, they were, all the same, they all went up or they all went down because you had massive monetary policy. Now you're getting massive dispersion. And one of the things that's interesting in fixed income now, emerging markets are interesting relative to some of the credit markets because of different inflationary dynamics. You're seeing real defaults in places like commercial real estate, parts of the lev loan market. So there's things to do in fixed income today that I think, particularly if you can actively manage it in today's environment, it's really interesting. I would argue there's not a big fat pitch for, is there a big rate trade? But I think there's a lot of things to do now, given we're going to see more volatility, more dispersion intra a lot of these markets.
One thing we can agree on, this market ain't boring right now. Rick Reeder, Mohammed Al-Erin, to the two of you. Wonderful. What a privilege, a pleasure to do this with you guys every first Friday of the month post payrolls. Big report from the payrolls report. Coming up, the morning calls and later, US jobs growth defying the gloom. More on the latest report with Anastasia Amoroso, PGIM's Mike Collins. That's still ahead.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
On track for another week of gains in the equity market. The S&P firmer, the Nasdaq higher, the Russell ripping going into the opening bell. That's the price action. Let's get you some morning calls. Bank of America upgrading universal health services, expecting better margins. Jefferies raising its Apple price target to 2 cents, saying next week's developers conference will serve as an upside catalyst. And finally, Piper downgrading Dollar General, highlighting a notable decline in quarterly comps. More on the retailers coming up shortly. We'll catch up with Anastasia Amoroso of iCapital and Mike Collins of PGIM. That's next, your opening bell, just around the corner.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
This is Bloomberg.
Big question going into payrolls. What on earth do you do with that payrolls report? Top line really strong, the rest of it not so much. Equity futures positive, dancing higher by 0.66% on the S&P. The Russell outperforming. The big cap tech story continues for a sixth consecutive week. Looking for another weekly gain. As the price action in equity, switch up the board and get to the bond market. Yields a little bit higher by a couple of basis points on a 10-year maturity. Back through 360. The bigger move at the front end on a 2-year. All over the place post payrolls, but higher now by 5 or 6 basis points, just short of 440. A touch of dollar strength briefly, it fades. The euro just about unchanged against the dollar. Euro dollar 107.69 and crude higher by 2.5%. Commodities up today off the back of speculation that we get some stimulus from China and reporting from the team here at Bloomberg that maybe China is considering doing something around the property market to support things just a little bit more. 30 seconds into the session, the broader equity market opens higher by almost 0.7% on the S&P, on the Nasdaq up by 0.8%. One stock to watch at the open, Lulu, topping Q1 earnings estimates and delivering a better than expected outlook. The CFO saying this, a meaningful acceleration in our China sales coupled with lower freight costs contributed to our better than planned performance. Abby has more. Hey, Abby.
Hey, John. Well, after 9 down days in a row, Lululemon, that was the longest losing streak for the stock going back to 2016. It is now up more than 15%. Its best day since June of 2018, and it has everything to do with that China strength that you were just talking about that allowed them to beat adjusted earnings by 16%. Sales were better by 4%. As you mentioned, they raised the full year outlook. A lot of it having to do with that China strength. It also has to do with the fact that they're finally moving through their bloated inventories. They rose just 24% from a year ago in the first quarter when they were up 50% year over year. Gross margins expanded. Executives at the company are saying that has a lot to do with China. They're also planning on opening 30 to 35 stores, many of them in China. So that China rebound that everybody's been waiting for, at least it's there for Lululemon. And it's interesting, John, because retail has been so mixed this year. This is another one of the brands, the higher end brands that retail consumers seem to be flocking toward. They're fashion right and being willing to pay up for this brand. Again, this stock right now up about 15%.
Abby, never mind this year, the last 24 hours. Just a story of contradictions. And Abby, thank you. Abby looking at Lulu there, absolutely fine flying. Nordstrom just about holding on. Macy's terrible. Dollar Tree telling you an ugly picture for the US consumer right now, and retail all over the place. Lulu right now up by close to 15%. Want to talk about the banks, the financials. Goldman warning of a 25% decline in trading revenue for the second quarter. The President John Waldron saying, quote, it feels like we're going to have a contractionary environment for a period of time. We're now embarking on additional targeted action with headcount. Kaylee has more. Hey, Kaylee.
Hey, John. Well, interesting to see Goldman actually positive here at the opening bell by about 0.4%, but we have to keep in mind the week through yesterday's close, it was down about 4.7%. So this rebound isn't likely to end in a weekly gain for this company. Of course, earlier in the week, we did get reports from here at Bloomberg that Goldman is looking at another round of job cuts, less than 250 jobs this time around, but that's after they cut 3,200 back at the beginning of the year and several hundred last fall. So the third round of cuts in less than a year, as they are contending not just with a 25% slump in the trading business, but other areas as well. Waldron talking about sluggish capital markets activity, the slowdown in deal making that is weighing on investment banking fees as the macroeconomic environment is just more difficult. And we heard echoes of this from Morgan Stanley as well. The co-president, Andy Saperstein, speaking on Wednesday, also said he expects that this quarter will be down year over year, that sales and trading is softer, investment banking is very challenged, and the industry has been what he described as a sustained trough since last year in investment banking. For Bank of America, though, John, the story is a bit different. We heard from Brian Moynihan, the bank's CEO, yesterday, saying that he expects trading and sales activity to be flattish this quarter. We have to keep in mind, though, that Bank of America is coming from a bit of a different breeze because it didn't have quite the performance in that division last year as some of the rivals did.
The bank's doing better today. Katie, for the wrap there. Thank you. Down in Washington, D.C. Nothing defensive about this equity market this morning. The underperformance from utilities, healthcare, the outperformance from materials, consumer discretionary, energy. There's a bit of an attacking pose to this equity market right now, up by 0.9%, even with the yields drifting higher at the front end by 6 basis points back through 440 on a 2-year. The slowdown weighing on earnings from Dow, though, feeling the pressure from weaker consumer PC demand. The company delivering a tepid outlook despite topping Q1 estimates. The stock just about positive. Katie has more. Hey, Katie.
Hey, John. Well, it wasn't as bad as feared, but it still wasn't good. We know that personal computers have been a tough sell. We saw that from HP earlier in the week. We saw it again from Dell today. So let's get specific here. Consumer PC sales plunged 42% in the period ended May 5th to about $2.12 billion. Analysts had been looking for about $2.3 billion. They did fare slightly better when it comes to commercial PCs. That segment brought in about $9.9 billion of sales, which was an 18% decline, but it still beat estimates. It was the outlook, though, that was lukewarm at best. Dell sees revenue between $20.2 billion to $21.2 billion in this current period. Now, on average, analysts had been looking for about $21.1 billion, so at the upper end of Dell's range. You look at what the stock is doing, and it's interesting. It had been lower pre-market. It's bouncing around right now, currently up about 0.5% or so.
Katie, thank you. I'll show you a bigger move than that. Year to date, and Katie, thanks again. Year to date, Apple up by close to 40%. Shares of Apple inching ever closer to an all-time high. We got 2 analysts raising their price targets today ahead of next week's developers conference. Morgan Stanley writing this: the combination of technological improvements and lower price points of the AR/VR headsets is what could make a conference a more significant stock catalyst this year. That stock up just a bit, 181, up by 0.6%. Want to stick on tech? Here's a story for you, buried by the news around the payrolls report in the last hour, but what a story. Bloomberg learning that Amazon has been in talks to offer mobile service to its Prime members in the United States. The report sending Amazon higher and telecoms lower. Ed Ludlow on that breaking news of the last hour or so. Morning, Ed.
Yeah, John, there's a lot to cover here. These are some pretty monster moves in reaction to this Bloomberg reporting. According to sources, Amazon is in talks with Verizon, T-Mobile and Dish. The idea, according to sources, is to get access to wholesale prices and then offer a low price, $10 per month or for free, to Prime members to give access to a wireless network. You look at Amazon up 2.3%, but I think we better take a quick look at the networks themselves, the carriers themselves. Dish is up now the most since 2011 at one point, up 19%. The idea is that, according to sources, it would give higher utilization for these newly built 5G networks. Whenever Amazon enters a new product category, it sends shivers into that industry. And you look at the reaction to the downside, Verizon, AT&T and T-Mobile. T-Mobile down 7.6%. That is the biggest drop since March of 2020 on that particular stock. The reasoning being that Amazon can undercut pricing because of its flex financially. So really interesting to see what this means for Prime, but also the future of those carriers.
Fascinating story. Ed, thanks for that. No doubt you and Caroline Hyde will be talking about this a little bit later on Bloomberg Technology. Look out for that in about 2 hours and 20 minutes time on Bloomberg TV. Amazon is doing okay. Dish Network's flying. The rest of the telecoms, it's not looking good out there at all. For the broader market, it's looking okay, better than okay, up 1% on the S&P 500. I mentioned there's so much going on right now, away from the payrolls report. You've got the China stimulus story, which we can talk about right now. Bank of America's Michael Hartnett writing the following this morning. The tech stocks have discounted a June Fed pause, leaving China stimulus as the bullish June surprise. He says the contrarian call here right now is to buy the Hang Seng and sell AI. Think about the beaten up parts of this market, commodities, EM, resources, and banks. And right on cue this morning, China is said to be considering a new package of measures to boost its economy and support the property market. That's one we'll be talking about going through the weekend. For us right now, we get lucky again. Joining us is iCapital's Anastasia Amoroso, alongside PGIM's Mike Collins. Anastasia, you get lucky too, because you've had about an hour to think about this labour market report, because everyone else is still confused by it. What's your take on it?
Well, look, I don't think the report is really as buoyant as the payrolls number actually suggests, because when you look at the household survey, and I do focus on this one a little bit more in this particular report, it is a more expansive measure that takes into account the self-employed people and household workers. And, you know, if you look at that, you do see a little bit of weakness, or at least loosening up in the labor market that's emerging. So I think the Fed is going to focus on that. The Fed is going to focus on the fact that wage growth is running a little bit slower this time around than it did the month before. So I actually think that's a positive, and that's how the markets are certainly interpreting in this. You know, I will say the Fed also has plenty of reasons to keep on hiking rates, because the data, the economic surprise continues to be so resilient. But in a way, they've sort of pre-committed to a pause. And I think given, again, you know, the weakness in the 3.7% unemployment rate, I think they can have enough credibility to pause in June.
Mike Collins, is so confusing. The labour market data at the very headline, payrolls growth this morning, together with claims earlier this week, job openings earlier this week, says there's nothing to see here, no problem. Then you go to the retailers and they're screaming, we've got a discretionary recession. Mike, which one is it?
Yeah, it's a lot of churn, Jonathan, and as Rick Reeder said, a lot of dispersion between winners and losers, not just in corporations, but among people, right? You are seeing that lower income bracket. As Mike McKee reported, African-American unemployment rate is jumping. You're seeing more distressed and highly levered companies really suffer in this environment. So that's something that everybody, including the Fed, really has to keep an eye on. But our base case, you know, when you see this volatility of numbers and it's really difficult to parse them, you step back, say, where are we heading in the big picture? And the base case is that, you know, growth is moderating. We're probably going to be running at 1% GDP in this country over the next 12 months. Inflation is moderating. We'll probably be running at a 3% inflation rate over the next 12 months. You add those together, you get 4% nominal GDP. That's not a world where the funds rate should be 5, nevertheless 6. I think to talk about taking it to 6 is kind of crazy. The markets, as you know, are pricing in one more full hike over the summer. And then kind of remarkably, 200 basis points of cuts from there pretty quickly over the next 17 months or so. So that's a real aggressive set of cuts, maybe overdone. The environment you described, Mike, sounds like by the NASDAQ 100. The NASDAQ 100 year to date is up by 33%. It's just a phenomenal rally. Anastasia, you've been constructive on tech. You've been constructive on this market. I remember several payrolls reports ago, you talked about breaking out of this tight trading range of 23 to the upside. Anastasia, we've done that. Can you make the argument now with conviction that now is the time to lock in some profits here?
Look, I think in parts of the market, it is absolutely the time to lock in partial profits. And in particular, I am looking at the NASDAQ. I'm looking at the semiconductors. I mean, the rally in semiconductor stocks, for example, has been stunning year to date. It's up 65%. And especially in the last couple of weeks, the semiconductor space has gone parabolic, which we all understand why, because semis are the key enabling technology of artificial intelligence. But anytime you see something move to the upside so far, so fast, so parabolic, you get into an overbought territory. And that's exactly where we are today. And then also, John, I look at the valuations of the semiconductor stocks, and the SOX index, for example, the valuation expanded from 13 times multiple at the October lows of last year to 28 times today. And don't get me wrong, I'm a huge believer in the semiconductor story and the artificial intelligence story. But if I take a tactical investor perspective near term, that's a sector that's looking stretched on positioning, on valuation, on technicals. And so for those reasons, I would want to take profits. And by the way, when you have this setup, you always are waiting for some sort of a negative catalyst. And we don't know which way the Fed is going to move in June, but I think there is scope for a hawkish surprise given how resilient the data has been. So if we have to reprice the path of Fed policy higher, then I think that's the ultimate negative catalyst for semiconductors. By the way, if
for that
we get a
debate,
dip, I want to buy it.
As you know, CPI on June 13th. Mike Collins, if we do leave these growthier parts of the equity market tech, you've got to make a decision whether you want to go back into the cyclical trade again. Mike, the cyclical trade just seems to have broken down. China disappointing, Europe disappointing. We reported earlier this morning that China might be considering stimulus measures. Mike, what gets that cyclical trade going again?
The Fed pausing for sure, not only skipping, but kind of signaling eventually, maybe over the next few months, that they really are done or really close to done. And the market's pricing of all these cuts have to continue to be in place, right? If the whole yield curve elevates higher toward that 5.25 funds rate, there's more pain to come, right? Multiples will compress, credit spreads will widen, the economy will weaken. So these cuts that are priced in may be aggressive in the near term, but wow, they have to really be sustained there for the economy to continue running.
Mike Collins is going to stick with us alongside Anastasia Amoroso. Coming up, the Fed's last word before going quiet.
We're getting close to a point where we can sit for a little bit. We really should skip, not pause. I don't like the word pause.
That conversation up next with Anastasia Amoroso and Mike Collins.
What's happening on Wall Street?
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. We had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Access the financial world on demand.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're getting close to a point where we can sit for a little bit in terms of policy. I don't know if we're exactly there yet, but I am in the camp increasingly coming into this meeting of thinking that we really should skip, not pause. I don't like the word pause, but skip an increase.
The committee at the Federal Reserve found a consensus on at least one thing. Don't call it a pause, call it a skip. Governor Jefferson leading the way this week. Skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. President Harker backing him up in many ways. We should at least skip this meeting in terms of an increase. We can let some of these things resolve themselves, at least to the extent they can, before we consider at all another increase. Federal Reserve officials getting in the last word ahead of the quiet period going into the next decision in just under 2 weeks away. Anastasia Amoroso, Mike Collins back with us. Anastasia, you mentioned this, and forgive me for jumping in a little bit prematurely, with regards to the Fed's next move. Morgan Stanley's Ellen Zentner saying this after the payrolls report: we do not believe today's report was strong enough to meet the bar for the Fed to hike in June, but it raises the risk that the Fed could hike in July. Anastasia, is that the way you're thinking about it too?
I think that's the scenario, John. I mean, if the Fed didn't really pre-commit, if the Fed didn't really make all the statements about the potential to have the leeway to pause, I think they would probably go in June. But, first of all, it's still only been a couple of months since the banking turmoil, and it's really just subsided in the last month or so. Second, the data has been somewhat mixed. So I think that does give the Fed some flexibility. But the main point is that Powell really said pretty strongly, saying we have the luxury to wait given how much we've tightened already. And I think they're likely to use that luxury. And here's the thing, John, we've had the Fed who went from hiking 75 basis points to hiking 25 basis points. But the next part of the tightening cycle may be that they maybe hike once a quarter. And, if that's the case, then, July might as well make sense.
We spoke to Mohammed in the last 50 minutes or so. Take a listen to what he had to say about the Fed's next move.
63.
We also know that the U.S. economy is increasingly dualistic between what's happening in manufacturing in general and what's happening in services. And all this, including today's job reports, complicates the Fed's policy challenge. Whether you call it a skip, a pause, or hike, it certainly complicates it.
Mike Collins, it makes it complicated for all of us. Mohammed mentioned what was happening beneath the surface of the economy. Manufacturing is screaming cut rates, services screaming you could stay where you are, maybe even hike. Mike, what are you meant to do with that information? How much weight do you put on each?
Yeah, it's really tough, right? And the markets are kind of right in the middle. They're pricing in about half of the hike in June and the other half in July. So they're pricing in one more hike for the cycle, which feels about right. It's hard to argue against that. But again, by the time, if they do skip in June, Jonathan, by the time the meeting in July, which is almost 2 months from now, our best guess is that you will continue to see more evidence that growth and inflation are moderating, and the Fed will probably be done for the cycle if they skip in June, would be my guess. And remember, you have to take all of the hikes into account, not just at the Fed, but globally. You add all the rate hikes around the world, Jonathan, over the last couple of years, it is multiples of anything we've seen in our lives. You add quantitative tightening, and as Anastasia said, the bank lending standards tightening pretty significantly. All that points to the funds rate is as high as it should go for the cycle.
I said this a little bit earlier. There's nothing boring about it right now. That's for sure, trying to work out all this stuff. Mike Collins, Anastasia Amoroso, to the two of you, thank you. Just always a stellar lineup on Payrolls Friday, and appreciate your time, as always, too. The equity market on the S&P 500, positive by 0.8%. The Nasdaq positive as well. The Russell doing nicely. In the bond market, yields were higher off the back of the report, higher again by 9 basis points at the moment, 443 on a 2-year. Further down the curve, 10-year maturity yields up there by 5 to about 3 65. Let's get you some sector price action. Here's Abby.
A solid rally for the S&P 500 indeed, John. In fact, the index is heading to its third up week in a row, the longest weekly winning streak since March. As for today, not surprisingly, with the strength, we have most sectors higher. In fact, we have 6 of them higher by more than 1%. Materials and energy, the top sectors, up about 2% or more. All the stocks in each of those sectors are higher. That's the kind of strength we're seeing today. As for the AI rally, it is strongly in place over the last 2 weeks. It's interesting, though, John. Earlier, NVIDIA had crossed the mark to $1 trillion market cap. Again, that stock now down. But over the last 2 weeks, you can see that tech, the stocks, NVIDIA, and C3 AI all on fire as the AI craze continues.
Over the last 6 weeks, NASDAQ 100, 6th weekly gain, longest weekly winning streak going back to July 2021. Abby, thank you. Up next on this program, we'll get you to the weekend. We'll take a look at the trading diary into the weekend and beyond.